चलो, very good morning everyone. How are you all, everyone? First, let me know, is the voice is audible or not? Is it clear? And I'm expecting the golden words from you all. Yes, Divya, very fine, very good, excellent. Palachandra, excellent. I want everyone that golden words. Yes, I'll be doing concept also, Alok. First, let me know that whatever chapters we have done. Last day we have done consolidation and business combination. Have you completed that chapter revision? Is by your own. Have you done the balance question? And that is clear. Everything is fine in that 2 chapter. Yes, Balaji, excellent. Bhuvnesh, excellent. Alok, excellent. Okay. Business combination completed. What about consolidation? Oh, Alok, you started today only. You started from today. Okay, nothing to worry. I think balance chapter you have done by your own. If not done, then do it. Yes, Sekhar. Excellent. Chalo, we'll start the revision. So what I have done in this financial instrument chapter, I will do the concept wise what are important from examination point of view. Okay, correct. So first I will read the concept, then I will do some question on that concept so that what to do, what not to do from exam point of view, you will be able to understand. Chalega? First important concept is compound financial instrument. Normally a question may come from compound financial instrument. I hope you all know the meaning of compound financial instrument. Any instrument, any contract which contain both element that is liability component and equity component, that is known as compound financial instrument. As per India as 32, we are supposed to split initially that instrument into 2 component, equity and liability component. Correct? Understood? Much we know. Correct? Now, what do you mean? How we'll understand whether it is a compound or whether it is not a compound instrument? Normally, whenever there is an instrument, always think about 2 particular point: interest or dividend, a principal component. There will be 2 component: interest or dividend and principal component. If there is an obligation to pay both component, that is a financial liability. There is no obligation to pay both component, then it become equity. But if there is an obligation to pay one component and there is no obligation to pay another component or vice versa, then it will be considered as compound financial instrument. Understood this point? Have you understood this point? Yes, sir. Correct. Now, normally in exam, whenever they say split into equity and liability, it means it is a question of compound financial instrument. Now, whenever such type of question come, you need to identify 3 rate of interest given in the question. What are the 3 rate of interest? One is known as contractual rate of interest. Contractual rate of interest will be always given in the question, and that is used to calculate contractual cash inflow or outflow. Of course, in this topic, that will be used to calculate contractual cash outflow. If not given the question, then it means contractual rate of interest is 0. If not given the question, it means contractual rate of interest 0. So if given the question, thank you very much. If not given the question, then it means so you can't assume any other rate of interest. Market rate of interest will be always given in the question. Market rate of interest will be always given in the question. Market rate of interest is always used to calculate fair value of that instrument. fair value of that instrument. Understood? The market rate of interest is always used to calculate fair value of that. Is in this concept we'll use market rate of interest to calculate fair value of liability component. What is point? The market rate of interest will be always given the question for this particular type of concept. For this particular type of concept, market rate of interest will be always given the question. If not given the question, means the question is wrong. If the question is wrong, then effective rate of interest is used to calculate amortized cost and interest expense. So whenever there is a effective rate of interest, it means that it will be calculate what? Amortized cost and effect and interest expense. So these are the three rate of interest which will be useful for this particular type of question. Can we proceed? Now in this question, whenever they ask the compound financial instrument question, first we need to identify proceed receive. Identify the proceed receive. Now identify the proceed receive. What will be the proceed? Proceed means nominal value minus discount or plus premium. Plus premium is either there will be discount on issue or premium on issue. Normally they will give discount only, so minus discount or premium. So at the time of issue, correct? Yes sir. So this is the proceed. Be careful, don't deduct transaction cost from this. This proceed may say don't deduct transaction cost. Normally you do mistake that you deduct transaction cost also from the proceed. So there is no need to deduct transaction cost to calculate proceed. The proceed means what? Nominal value minus discount plus premium. Then second step is what? Identify the contractual rate of interest and calculate contractual cash outflow. So we need to calculate contractual cash outflow in this particular type of question. Now there are two components to find out contractual cash outflow. One is known as contractual interest payment. Now contractual interest payment will be always calculated by applying contractual rate of interest on nominal value. So nominal value multiplied by contractual rate of interest, that is known as contractual interest payment. Correct? Nominal value multiplied by contractual rate of interest. I hope you have understood this point. Everyone say yes sir, yes sir. Correct? The contractual interest payment. But the second component to find out contractual cash flow is contractual principal payment. So if it is compulsory convertible instrument, then contractual principal payment will be nil. However, if it is compulsory redeemable or optionally convertible, then contractual principal payment will be equal to redemption value. Redemption value means, what do you mean by redemption value? It means nominal value plus premium at the time of issue minus plus premium at the time of redemption or minus discount at the time of redemption. Understood? Plus minus premium or discount at the time of redemption. Got this point? So be careful about optionally convertible. Then also contractual principal payment will be equal to redemption value. Understood this point? Got this point? Everyone respond fast. Correct? Yes sir. If question is silent, always assume the question is silent and they have given convertible instrument, so always assume it is optionally convertible. If the question is silent, then always assume it is optionally convertible. Got this point? The question has given convertible instrument, but they have not given whether it is compulsory convertible or optionally convertible. Then always assume optionally convertible and do the solution. Understood? Second step you understood. Then we need to identify the market rate of interest. Market rate of interest will be always given in the question, and calculate the fair value of liability component. So what will be the fair value of liability component? Fair value of liability component will be present value of all the contractual cash outflow, whatever you have calculated in step number 2, discounted by using market rate of interest. Correct? So this you can easily do. Present value of contractual cash outflow discounted by using market rate of interest. So step number 3 is very easy. Then we need to find out fair value of equity component. So fair value of equity component will be proceed as calculated in step number 1 minus fair value of liability component as calculated in step number 3. That will be fair value of equity component. This will be always like this. Means you can't first calculate fair value of equity component and residual balance cannot be fair value of liability component. Means always first calculate fair value of liability component, the residual balance will be fair value of equity component. Understood this point? Yes sir. Then up to this is splitting part. This is Ind AS 32. Up to this it is Ind AS 32. Means based on this Up to this is India's 32. Then the question can also ask some other point. Then identify whether transaction cost is given in the question. Transaction cost is given the question. Normally they don't give transaction cost, but if they have given transaction cost, then transaction cost whatever given the question, what India's 32 says that it will be allocated to both the component in the ratio of their fair value. So you need to do allocation. So you need to calculate the ratio of fair value. Fair value already you have calculated. Now this fair value first liability equity component and the transaction cost, this transaction cost will be allocated in this ratio, correct. Now after allocation of transaction cost, we need to find out net proceed for both the component. So fair value minus transaction cost become the net proceed, understood this point? Have you understood this point? So we pass journal entry, initial journal entry with the net proceed. We pass initial journal entry with the net proceed. So what will be journal entry? Initial journal entry, bank account debit to financial liability to equity component, means equity instrument, financial liability to equity instrument based on the net proceed. If this net transaction cost is not given, then pass the journal entry with the fair value of the liability and equity component. I hope this point you have understood. Correct. Up to this any doubt? Follow. Have you understood the splitting part? बोलिए. No doubt, sir. Now, after that question may ask you to calculate amortized cost and interest expense also as per Ind AS 109. What Ind AS 109 say that financial liability will measure at amortized cost by applying EIR. Understood this point? Have you understood this point? However, we don't do subsequent measurement of equity instrument. To equity instrument we remain as it is till the conversion date. To equity instrument will remain same, but the financial liability, this will be subsequently remeasured as per Ind AS 109. For that purpose, we need to identify effective rate of interest and calculate amortized cost of financial liability as per Ind AS 109. Now, what will be the effective rate of interest? If the transaction cost is, we need to just find out, is the transaction cost given the question? If the transaction cost is not given the question, then EIR will be equal to market rate of interest. Then there is no need to calculate EIR. Whatever market rate of interest, that will become EIR. So whenever transaction cost is not given the question, then EIR will be equal to market rate of interest. But if the transaction cost is given the question, then EIR is not equal to market rate of interest, then of course EIR will be given the question, correct now, which will be different than market rate of interest. If not given, however 99% EIR will be given the question, but if not given, then we have to calculate EIR by applying the concept of IRR, internal rate of return. So ER in that case will be rate of interest at which present value of contractual cash outflow should be equal to net proceed of financial liability. Have you understood? However, EIR 99% EIR will be also given the question. So you need to identify EIR. Have you understood this concept? Once you have identified EIR, then you calculate amortized cost and interest expenses by using the amortization cost table. So year 1, 2, 3, 4, whatever is given, write down opening liability, then plus interest by applying EIR, then minus contractual cash outflow. This will be closing liability, and closing liability will be nothing but amortized cost. Understood? Up to this any doubt? So we'll take one question based on this. Have you understood this much? So come to this question number 3, already asked in exam, can be again asked. This is one question in which all the informations are given, correct? What is given? ABC company issued 10,000 compulsory cumulative convertible preference shares as on 1st April 2001 at 150 each. The rate of dividend is 10%, payable every year. Means, can I say it become fixed dividend? There is a cumulative dividend which is fixed. So can I say there is an obligation to pay dividend, but there is no obligation to pay principal amount because it is compulsory convertible. The preference shares are converted into 5,000 equity shares of the company at the end of 5th year from the date of allotment. So this information is actually not relevant. Ki how many number of shares will be issued at the time of conversion. This is not required for initial classification. However, it is fixed number. However, it is fixed number of equity shares. I will just explain one more point regarding this, but after doing this question. When the CCPS are issued, the prevailing market rate of interest is given 15%. The market rate of interest is given. So what is the contractual rate of interest? 10% become the contractual rate of interest. Market rate of interest become what? 15%. And the transaction cost they have given to 2%. Whenever transaction cost is given, then ER will not be equal to market rate of interest. So of course ER will be given. You can see the last point, ER is given 15.86. 15.86. Calculate the value of liability and equity component. This is the question. This is the question. So what we'll do? First we'll find out contract proceed. Proceed is what? 15 lakh is the proceed, because there is no discount, there is no premium in this question. Then we'll find out a contractual cash outflow by using 10%. Only there is an obligation to pay dividend, because there is compulsory convertible. The principal amount, there is no contractual cash outflow. So 10% into 15 lakh, to 1,50,000 every year will be the contractual cash outflow. So you have calculated contractual cash outflow. You can see the dividend 1,50,000, 1,50,000, 1,50,000, 1,50,000, 1,50,000 is the contractual cash outflow. Correct? So then you need to identify market rate of interest. Market rate of interest is given. That is given how much? How much they have given? They have given market rate of interest 15%. So calculate the present value by using market rate of interest, and this become the present value, and this become the fair value of liability component. You calculated fair value of liability component. From that deduct proceed. So if you deduct proceed, you will get the fair value of equity component. This become fair value of equity component. Correct? Now then identify whether the transaction cost is given the question. Yes, the transaction cost is given the question. Transaction cost is 2% of proceed. So 2% of 15 lakh is 30,000. This 30,000 will be allocated to fair value of liability component and equity component in the ratio of their fair value. So this you can see this 30,000 has been allocated to liability component and equity component in the ratio of their fair value. So this amount is allocated amount, and this amount become net amount. This amount become net amount. We will pass our initial journal entry based on the net proceed. So what journal entry will do? Bank account debit 14,70,000. Bank account debit 14,70,000 to financial liability, it is 4,92,767, and to equity instrument is 9,77,233. However, in exam you just write down journal entry like this: bank account debit to 10% CCPS in bracket write down financial liability, then to 10% CCPS in bracket write down equity instrument, because we cannot change the name of the instrument. The name of the instrument is what? Compulsory compulsory cumulative compound compulsory cumulative convertible preference share. So you can't change the name of the instrument. Understood this much? Then of course can I say now we need to find out EIR. So EIR is given the question, that is 15.86%. Not given in the question, so you can calculate it by using the concept of IRR. Understood? Yes sir. However, 99% that will be given the question. Now based on that EIR, you need to prepare one amortization cost table. So you can see your opening liability is this. On that, calculate interest by applying 15.86%, then minus contractual cash outflow. This will become the amortized cost of first year, and then carry on it for second year, third year, fourth year, fifth year. In fifth year, automatically the amortized cost will become nil. So this become the interest expense, which will be charged to profit and loss account as an expense. Understood? Correct? Journal entry, I hope no doubt in journal entry. Journal entry, they ask, you can do it. I hope in journal entry, no doubt, respond. Do you want me to do the journal entry also? Hello. Up to this, the first question done, first concept done. Correct? Now, this much you understood? This much you understood? So just try to understand this point. Convertible instrument, can I say it can be compulsory, if it can be optionally? Correct. Compulsory, they can be fixed number of equity shares, they can be variable number of equity shares. Optionally, also there can be fixed number of equity shares, variable number of equity shares. This can be the four situation. Till now in ICS study material, they have given this type of question, this type of question. Till now they have not given any question where they are issuing variable number of equity shares. They are issuing variable number of equity shares. Is the voice is not clear? Everyone? Everyone, is the voice is not clear? Now is it okay? Now just see, is it okay? Now, have you understood this point? So till now, whatever question they have given, now I think it will be clear. The mic was not kept properly. Now is it clear? Now where the sound is coming? On fast. And my actually voice is, my throat is actually gone. But last 4 days I am taking 9 hour class, 3 hour my regular class, then 6 hours. So it has been purasa damaged. But still I am taking the classes because I have committed to all that I will complete this. Correct now? So it might be because of my throat also. So the voice has become thoda heavy. Is it now okay? Okay, sir. Okay. So what I am saying, convertible instrument, suppose they have given a question about compound financial instrument and there is a convertible instrument. It can be compulsory, it can be optionally. Till now, whatever question they have given in ICS study matter, in all questions there are fixed number of equity shares. And suppose they have not given any fixed or variable, we have assumed that it is fixed number of equity shares. But now we all know that whenever there is a variable number of equity shares, it will be initially classified as financial liability. Now be careful. Suppose they have given this. So in this case, just try to understand. For principal component, contractual cash outflow will be nil. In this case, principal component will be redemption value. Initially it will be redemption value. In this also it will be redemption value. This also it will be redemption value. Because optionally it is contingent. Whenever there is a contingent settlement, then initially always the principal component will be classified as financial liability. You can see in this all the principal component will be initially classified as financial liability. तो हो सकता है in your exam they have given compulsory convertible with variable number of equity share. So be careful. Initially it will be classified as what? Financial liability, and do accordingly. Then have you understood this point? Follow. Have you understood this point? Got this point? So compulsory, till now they have not given compulsory with variable. They have given compulsory which will be settled by issuing variable number of equity shares. Then initially the principal amount will be classified as liability. In that case, the principal component, the contractual cash outflow, will be equal to redemption value. Got this point? Yes, sir. It is all FR is beneficial for IBS also, because if in IBS they are asking question from FR, that will be based on India. So if you know FR, you know IBS related to what? Related to FR. Chalega? Understood this also? Now come to concept number 2. This is also very important concept. Early settlement of compound financial instrument. Early settlement. Suppose there is some early settlement of compound financial instrument. Correct now. For example, a compound financial instrument was given for 10 years, but it has decided to repurchase that compound financial instrument after 4 years, yeah, after 5 years only. That is known as early settlement. That question, first you calculate the amortized cost of liability component. on the date of repurchase by using all the concept whatever we have done in concept number 1. Correct now? So first treat the compound finance instrument on initial date and find out the amortized cost of liability component on the date of repurchase by using all the above step of concept number 1. This you have understood? Correct. Now identify the fair value of the consideration paid for buyback of compound finance instrument. Now whatever is the fair value of consideration paid for buyback on repurchase date, that will be given the question that we need to identify, and that fair value of consideration paid will be now split into liability component and equity component, by using the same concept. So what will do, fair value of consideration paid whatever is given, then less fair value of liability component on repurchase date. Fair value of liability component on repurchase date. So what will be this? This is nothing but present value of remaining contractual cash outflow. Present value of remaining contractual cash outflow discounted by using current market rate of interest. Means current market rate of interest means what? The market rate of interest on repurchase date. On repurchase date. Understood this point? So you need to find out fair value of liability component. Fair value of liability component on repurchase date based on market rate of interest on repurchase date, that will be equal to present value of remaining contractual cash outflow discounted by using current market rate of interest on repurchase date. The residual amount will be fair value of equity instrument on repurchase date. Got this point? Once you have calculated fair value of fair value, once you have splitted the fair value of consideration paid into two components, then you need to find out gain or loss on repurchase. How to calculate this? So this will be liability component, this will be equity component, this will be total. So fair value on this repurchase date, fair value on repurchase date already we have split, so this will be the split part. Correct? Whatever we have done is step number 2. Correct? Then carrying amount on repurchase date, this is as per step number 1. Step number 1, we have calculated amortized cost on repurchase date, equity component. There is no subsequent remeasurement, so this will be the initial carrying amount what we have done on initial recognition date. So this will remain unchanged. Equity component will remain unchanged, so that carrying amount will remain same. The difference will be this is gain or loss on repurchase of equity component and liability component. Only you need to be careful that any gain or loss on liability component will be transferred to PL. Any gain or loss of equity component will remain in other equity only. Means it can be directly transferred to retained earning. Means this will be transferred retained earning. This will be transferred to PL. So what journal entry will do? Journal entry will what? Financial liability account debit with carrying amount to bank with the consideration paid, the allocated consideration paid. The difference will be gain or loss that will be transferred to PL. For equity instrument, you will add on equity instrument account debit to bank. Bank will be with the amount of allocated consideration paid. The difference will be transferred to other equity. Other equity means you can transfer it to retained earning. Got this point? Have you understood? Abhi, in this matter, in this revision class, we are only covering 2 chapters. One is what? Financial instrument. One is what? We are covering Ind AS 1 and 5. If you want to do all the Ind AS, so already I have done one revision of all Ind AS in the month of Feb. That is already in YouTube, that you can watch. But Abhi, right now, that is the 60 hours classes, so that is more than enough for that IBS. Understood? Yes, sir. Have you understood this concept number 2? Concept number 2 you have understood? Correct. So there is one question based on this in ICS study matter that you do by your own. Correct now. So can you do this question by your own? I have done the concept. I hope you have understood this point. Concept number 2. Just respond. If you say yes, I will proceed. If you say yes, I will proceed, or I will take one question also if you want to take me that question. Correct now, but I don't think so the question required. You can do practice by your own, because this is totally calculation based. Calculation you are supposed to do. If you know the concept, you can do calculation by your own. Have you understood this? Respond fast. Done? Yes, sir. Thank you very much. Then concept number 3, which is also important from examination point of view, is the financial asset measured at amortized cost. Normally we know that financial asset can be measured at as per 3 category: at amortized cost, at FBTPL, or at FBTOCI. Normally they don't ask any question on FBTPL or FBTOCI. If they ask, that will be very simple question. So normally from examination point of view, they ask financial asset at amortized cost. So we are taking that concept. Chalega? We are taking that question. Understood what I am saying? So financial asset measured at amortized cost. Now, in this case, first you need to just understand that financial instrument is at market terms or is it not at market terms. So if the financial instrument is at market terms, it means contractual rate of interest and market rate of interest are same. It means contractual rate of interest and market rate of interest are same. So whenever market rate of interest is not given, we'll assume it is at market terms. It will be assumed that it is at market terms. Whenever in this type of question they have not given market rate of interest, it means the contract is at market terms. It means contractual rate of interest and market rate of interest are same. If correct. Now in this case, the fair value of the financial asset initially will be always equal to transaction price paid. Means whatever you are paid, that is only fair value. There is no need to calculate fair value, because the present value of contractual cash inflow discounted at market rate of interest, that is contractual rate of interest, will be the same amount. So there is no need to calculate fair value. However, in exam normally they ask this type of question. Why? Because this will be thoda interesting when the financial instrument are not at market terms. In this question, they will give you contractual rate of interest and market rate of interest, and market rate of interest will be different from contractual rate of interest. So whenever contractual rate of interest is not equal to market rate of interest, then fair value of financial asset is not equal to transaction price paid. In this case, you need to calculate fair value of financial asset, which is equal to present value of contractual cash inflow discounted at market rate of interest. Market rate of interest is always used to calculate fair value. So in this case, fair value will be equal to present value of contractual cash inflow discounted at market rate of interest. This much you understood? If the question has provided information about market rate of interest which is different from contractual rate of interest, it means it is a question of financial instrument at off market terms, and normally they will provide this type of questions only because this is only interesting from examination point of view. Correct? Yes, sir. The following steps will be taken into consideration: identify contractual rate of interest and calculate contractual cash inflow. Once again, contractual cash inflow will be interest component and principal component that you can find out. Then identify market rate of interest. This contractual rate of interest, if not given, it means it is zero. So sometimes contractual rate of interest not given means that a financial asset, the contractual rate of interest is zero. Don't assume that it is equal to market rate of interest. Got this point? Yes, sir. Then identify market rate of interest. Of course, whenever it is at off market terms, market rate of interest will be always given in the question. If not given the question, it means the contract is at market terms, but that type of question they will not ask. So identify market rate of interest and calculate fair value of financial asset. So step situation 1, if instrument are at market terms, then fair value will be equal to transaction paid, but this type of question they will not ask. So they will ask situation number 2 only. If the instrument are at off market terms, then transaction price paid minus karo fair value of financial asset. Fair value of financial asset will be present value of contractual cash inflow discounted at market rate of interest. This you deduct. The difference will be extra amount paid. This difference will be considered as extra amount paid. Now this extra amount paid will be accounted as per the substance of the contract, as per the nature of the contract. So there are 4 or 5 questions given in the exam. So this will be accounted as per the substance of the contract. If this is a question of concessional loan to employ, then this extra amount paid will be identified as prepaid EB expense. Then identified as prepaid EB expense. If this extra amount paid is the deposit given for lease, one question is about deposit given for lease, then this extra amount will be considered as ROU asset. Correct? So it will be considered prepayment for lease contract. The any prepayment for lease contract is always identified as ROU asset. If the question is of concessional loan to subsidiary company, concessional loan to subsidiary company, then his extra amount will be considered as investment in the equity instrument of subsidiary company. Then this extra amount will be considered as investment in the equity instrument of subsidiary company. If this is a question of concessional loan by subsidiary company to parent company, by subsidiary company to parent company, then extra amount paid will be considered as dividend distribution, dividend distributed to parent company, dividend distributed to parent company. Normally they ask this type of question, means this type of question has been given in ICI study material. Suppose they ask some different type of question, so in exam hall apply your common sense and do it. Apply your common sense, do it. However, one more point, if there is no future economic benefit, means suppose some extra amount is paid without any future economic benefit, then this extra amount will be charged as an expense immediately to profit and loss account, to profit and loss account. Got this point? Have you understood this point? So suppose you are not able to understand why this extra amount has been paid, then this extra amount paid will be recognized as an expense and charged to profit and loss account as an expense immediately. Have you understood this much? So I'm just revising all the questions. So I'm just revising all the questions. Got this point? Any doubt? Up to this, any doubt? Everyone respond fast. Understood? Yes, sir. Correct. Now, once you have calculated fair value of financial asset, then of course they can be identify any transaction cost. Transaction cost may be given the question, but till now no question of this nature has been given in ICI study material where they have given transaction cost. Till now they have not given. Till now they have not given any question of this concept where transaction cost is given. But identify transaction cost and recognize financial asset initially at fair value plus transaction cost, and we recognize financial asset initially at fair value plus transaction cost. Correct? Now suppose they have given transaction cost, suppose they have given transaction cost, I will take question of ROU asset. Don't worry Balaji, I will take one question of ROU asset, but just try to understand whenever extra amount paid for a lease contract in this type of question, that will be ROU asset. I will take that question, don't worry Balaji. Correct? Got this point? Now identify any transaction cost given. Till now no question of transaction cost has been given ICS study material, but in your exam if they are given, then initially initially recognition of financial asset will be at fair value plus transaction cost. Then your journal entry will be financial asset account debit at fair value plus transaction cost. Financial asset will be recognized at fair value, whatever you have calculated in above step, fair value plus transaction cost. Difference will be accounted as either asset or expense as the case may be. Means it can be ROU asset, it can be prepaid EB expense, it can be investment in equity instrument, whatever. Correct? Now the difference will be accounted as it is, and two bank will be what? That transaction price paid plus transaction cost, plus transaction cost. Have you understood this journal entry? But till now no question has been given whether transaction cost has been given in the question. Got this point? To normally if the transaction cost is not given in the question, then the financial asset will be recognized at fair value only, at fair value. Have you understood this point? Then of course we need to identify EIR. Identify EIR. So if the transaction cost is given, if the transaction cost is not given, then can I say EIR will be equal to market rate of interest? Normally all question of ICI study material is of this nature. All question of ICI study material is of this nature where they have never given transaction cost for this type of questions. I hope you are understanding. If the transaction cost is not given, then EIR will be equal to market rate of interest. Correct? Now but if the transaction cost is given, then of course EIR will not be equal to market rate of interest. In that case EIR will be given the question. If not given, then calculate it. If not given, then calculate it. Correct? I hope you are understanding. So normally till now no question of this nature has been given in ICS study material. But be careful, if the transaction cost is given the question, then EIR will not be equal to market rate of interest. Once you have calculated EIR, then calculate amortized cost of that financial asset by applying EIR. Same format amortized cost table. So opening receivable plus interest at EIR plus interest calculated by applying EIR minus contractual cash inflow. This will be closing receivable and this will be amortized cost. Understood the statement done? Have you understood this much? Any doubt? Any doubt? No doubt. We'll take one question. We'll take one question. To ask ROE asset, that question. Question number 2 में आ जाओ. A Limited has made a security deposit whose details are described below. Make necessary journal entry for accounting of deposit. Assume market rate of interest is 12% per annum. You only say in this case, बताओ what will be the contractual rate of interest. Everyone respond. What will be the contractual rate of interest? देखो contractual rate of interest not given. It means contractual rate of interest will be 0. Contractual rate of interest will be 0. Correct now. You can see market rate of interest and contractual rate of interest are different. It means it is at off market terms, off market terms, off market terms, off market terms. Yes, sir. Then they have given date of security deposit, date of finishing date, means this is for how many year? 5 year. The description is lease contract. It is a lease contract. Discount rate is given 12%. This is nothing but market rate of interest. You can see no transaction cost is given. If the transaction cost is not given, it means ER will be equal to market rate of interest. ER will be equal to market rate of interest. Got this point? Determine how the above financial statement should be measured and briefly explain the measurement determined as such. Make necessary journal entry for accounting of security deposit in the first year and last year. They have asked only first year and last year journal entry. Okay, sir. Now first identify contractual rate of interest. That is 0. That is 0. So can you say in this case the contractual cash inflow will be only one component, that is principal component, and that will be receivable. That will be receivable at the end of 5th year. That will be receivable at the end of 5th year. Means contractual cash inflow regarding interest component will be 0 because contractual rate of interest is 0 only. It means, can I say, now we need to identify market rate of interest. Market rate of interest is given 50, how much percent? 12%. Now we need to find out fair value of financial asset. Fair value of financial asset, that will be equal to present value of contractual cash inflow discounted at 12%. 12%. They have given discounting factor 0.567427. Apply on what? The amount apply on what? Contractual cash inflow. So you can see they have done 10 lakh multiplied by this is equal to what? Present value is what? 5,67,427. So this become the financial asset. This become the financial asset. Now transaction price paid minus fair value of financial asset will be equal to what? Difference amount. So difference extra amount paid is what? 4,32,573. So whatever extra amount you are paid for obtaining a asset on lease, that is nothing but you are paid to acquire one ROU asset. You are paid to acquire one ROU asset. So this extra amount has been paid to use one ROU asset. To use one ROU asset. So your initial journal entry will what? The security deposit is only 5,67,427. This can be also considered loan receivable. So this is loan receivable account is itna, and the difference amount will be ROU asset account debit to bank. Have you understood? Have you understood this point? This is the initial journal entry. Now on this we'll apply IND AS 109. We can calculate amortized cost table by applying EIR. So EIR is what? EIR is what? Effective rate of interest will be 12% only. So I don't think they have done. So you can prepare one amortized cost table by using 5,67,427, and for this ROU asset you need to apply IND AS 116. Now IND AS 116 says that ROU asset need to be depreciated during the lease term. During the lease term, if the ownership is not transferred at the end of lease term, so of course this will be depreciated in how many year? 5 year. It will be depreciated in how many year? 5 year. Understood? Have you understood this entire point? So first year journal entry, you need to also recognize one interest income. Interest income will be calculated on 5,67,427 by applying 12%. So what journal entry will do? What journal entry? Financial asset account debit to interest income. You can see they have done financial asset account debit to interest income by applying 12% interest. There is no contractual cash inflow in the first year because the contractual rate of interest was 0. And depreciation, they have done depreciation to ROU asset for 5 years. So divide by 5 kar diya. Divide by 5 kar diya. Same journal entry will be recorded in 2nd year, 3rd year, 4th year and 5th year. At the end of 5th year, ROU asset will become 0 and the security deposit will become 10 lakh. The amortized cost will become how much? 10 lakh, which will receive. So received entry will be what? Bank account debit to security deposit. Understood? Have you understood this, and this question? This is expected, 100% expected in exam. 100%, no 100% नहीं बोलेंगे, 95% virtual certainty है. This question may come in exam. This question may come in your exam. This time I am expecting this question. Have you understood this? Hello. Yes, sir. One more question I will take. One more question I will take for this concept. This question. A Limited issued redeemable preference shares to a holding company, Jet Limited. So A Limited has issued redeemable preference shares to holding company, correct? The terms of the instrument have been summarized below. Account for this in the books of Jet Limited, means in the books of parent company. This parent company has subscribed the redeemable preference shares of holding of subsidiary company, correct? Now it means they have given some amount. They have given some amount to subsidiary company. Correct now. So in their books, it is investment in preference shares. Investment in preference shares will be a financial asset. Investment in preference shares will be a financial asset. It means this question we are doing from holding company point of view, where we have some financial asset. The nature is what? It is a non-cumulative redeemable preference shares. Non-cumulative redeemable preference shares. Now repayment is what? Redeemable after 5 years. Date of allotment, date of repayment. Correct. Total period 5 years. Value of preference share is how much? Is how much crore? 10 crore. It is 10 crore. It is 10 crore. Dividend rate is 0.001%. So can this become contractual rate of interest? Contractual rate of interest. Correct now. However, you can see it is a non-cumulative redeemable preference shares. When I say non-cumulative redeemable preference shares, therefore dividend will be always at the discretion of the entity. Therefore, can you say there is no obligation to pay this dividend? If there is no obligation to pay dividend, so there is no right to receive such dividend. However, can you say this is very nominal amount? This is very insignificant amount also. I hope you are understanding. And the market rate of interest is 12%. Market rate of interest is 12%. So you can see market rate of interest and the contractual rate of interest are different. However, this 0.001% is a very nominal amount. This will come only 100 rupees. This will come only 100 rupees. Present value factor they have given 0.56743. Correct. So I will say in this case, because it is a non-cumulative dividend at the discretion of the entity, therefore there is no obligation to pay dividend, therefore there is no right to receive dividend. Correct now. So only can I say whatever amount we have given, that is only the amount, because that is a redeemable preference here, so that amount will be received. Only the inflow is what? 10 crore is the inflow. 10 crore is the contractual cash inflow. 10 crore is the only contractual cash inflow. Correct. So one thing we have understood, that this is not at market term. This is not at market term, because the rate of interest are different. The rate of interest are different. Once again, this question, transaction cost is not given. Transaction cost is not given. Then ER will be equal to market rate of interest. ER will be equal to market rate of interest. First, we'll find out the fair value of financial asset. So fair value of financial asset will be the present value of contractual cash inflow, which will be equal to 10 crore multiplied by this factor. So this will come 56 lakh 74,000 5 crore 67 lakh 42,686. When you deduct this from 10 crore, so the balance amount will be this 4 crore 32 lakh and change amount. So this will be the investment in equity of subsidiary company. Will be considered as investment in the equity instrument of subsidiary company. I hope you have understood. Correct. So what initial journal entry will do? The initial journal entry is what? Investment account debit, loan account debit, loan receivable account debit to bank. Correct. Now investment will be accounted as per Ind AS 27. Now it will remain in the balance sheet as it is, because as per Ind AS 27 it will be initially measured at cost price. So we will not do any subsequent accounting of this investment in separate financial statement. I hope you are understanding. Now this loan receivable will be subsequently recognized at amortized cost. So we have prepared an amortized cost table. You can see the opening balance, then interest will be calculated. This days ko bhul jao, interest calculate on per annum basis, we don't calculate on days. Correct? Now they have given, pata nahi, I don't know why they have given, so apply directly 12% for the entire year. So this will be interest component. This contractual cash inflow is 0,000 every year. The last contractual cash inflow will be 10 crore. This will be the 10 crore. This become amortized cost. This become amortized cost. I hope you have understood. Right. Then we can pass subsequent journal entry, loan receivable account debit to interest income. Correct. Then loan receivable account debit to interest income. Then there is no contractual cash inflow. You can see every year they are doing loan receivable to interest income, 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 and at the end of the 5th year, the amortized cost will become how much? 10 crore, and that amount will receive bank account debit to loan receivable. Understood? Have you understood this question? This is also good question, can be asked in exam. Can be asked in exam. Have you understood? In one of the exam, what they have asked, the loan is given by subsidiary company to parent company. In that case, the difference amount will be dividend distribution. So be careful. At that point of time, the loan has been given at off-market terms by subsidiary company to parent company. In that case, the difference amount will be the dividend distribution amount. Dividend distribution amount. That dividend distribution will be debited to retained earning. That will be debited to retained earning. Then our journal entry, if suppose this is a question of loan given by subsidiary to parent company, then our journal entry will what? Journal entry will what? The loan receivable account, retained earning account debit is dividend distribution to what? Bank. Then we'll pass this journal entry, and then this for loan receivable will apply what? Amortized cost. By applying will recognize that amortized cost by applying EIR. Understood? Got this point? This concept also done. This concept also done. Correct? Correct. Now concept number 4 is what? There can be some modification in estimated contractual cash inflow. Sometimes what happen, we estimate contractual cash inflow, and that estimated contractual cash inflow is modified due to some reason. But this is other than impairment. We are not doing impairment right now. This is other than impairment. Other than impairment topic. Other than impairment topic. If there is a modification in estimated contractual cash inflow, if there is some modification in estimated contractual cash inflow, there is only one question regarding that, and that too has been asked in exam. That is also important. So first we will calculate amortized cost of financial asset on the modification date as per previous concept. Correct? Now, so first find out amortized cost of financial asset on modification date as per previous concept. Then calculate a revised amortized cost. We need to find out, calculate a revised amortized cost on modification date. On modification date due to what? Due to modification. So what will be the revised carrying amount? Revised carrying amount will be the present value of modified contractual cash inflow. Modified contractual cash remaining. Modified remaining contractual cash inflow discounted by using original EIR. Discounted by using original EIR means you will use original EIR. Correct? Because just try to understand, whenever you calculate carrying amount, whenever you calculate revised carrying amount means amortized cost. So for amortized cost, you will not use market rate of interest. You use original EIR only. Original effective rate of interest. Correct? So revised carrying amount will be present value of modified contractual cash inflow, remaining modified contractual cash inflow on modification date by using original EIR. Now compare revised carrying amount with original carrying amount, means step number 2 with step number 1, and find out the difference. Find out the difference. Find out the difference means either the financial asset will decrease or increase due to that modification. Understood? Either the financial asset will increase or decrease. So this will be adjusted. This will be adjusted with which account? This will be adjusted with the differential amount which you have taken on initial recognition. Is when we have the initial recognition, the whatever extra amount was paid, that was either debited to prepaid EB expense or ROU asset or investment account, whatever. Correct? Now, or expense. So this will be adjusted to that initial differential account. Initial differential account. I hope you have understood. So this will be adjusted with initial differential account. Suppose this is a question of concessional loan to employee. So initially the difference amount has been debited to prepaid EB expense. So this difference will be also adjusted with prepaid EB expense. Correct? Then you need to prepare amortized cost table by using revised carrying amount, applying original EIR, by applying original EIR. OER means original EIR. Original EIR means what? What EIR you have taken on initial date, on initial recognition date. चलेगा? Doubt regarding calculation of lease by lesser the finance by using original date or revised discount because as per ये क्या है? What is this question? What is this question? Lease accounting will be done as per Ind AS 116. I am not teaching Ind AS 116. There is a modification in some modification in lease receivable. Then you do as per Ind AS 116. I am not right now teaching Ind AS 116. Okay, sir. Correct now. Understood what I am saying? Listen, Eddie. चलेगा? You will take one question based on this. Come to this one question related to Will Company Limited. This question. I have not taken that question here. Okay. Can I take that question from my question bank? Yes, we can take. Only one question is there. Let us do that question also for practice. Can I take that question if you permit me? Permission granted. Balaji, what is your doubt? Sir, small doubt regarding discount factor. What is your doubt? Hello? The question 29. Will Company Limited has a policy of providing subsidized loan to its employee for the purpose of buying or building houses. Mr. X, who's executive assistant to the CEO of Wheel Company Limited, took a loan from the company on the following terms. Principal amount is 10 lakh. Interest rate at a rate of 4% for the first 4 lakh and 7% for the next 6 lakh. So this is the contractual rate of interest. This is the contractual rate of interest. Start date is 1st Jan 2001. Tenure is 5 year. Prepayment, full or partial payment at the option of the employee. There is a prepayment option has been given. Either the employee can pay in full or partial at any point of time. The principal amount of the loan shall be recovered in 5 equal installments. Means if suppose they are not availing prepayment option, then they need to pay the entire amount in 5 equal installment. 5 equal installment means what? 10 lakh divided 5, so 2 lakh for each year, and will be first applied to the 7% interest bearing principal. First, this loan will be adjusted with the 7% interest bearing 7% interest bearing principal amount, okay, and then 4% interest bearing principal amount. The accrued interest shall be paid on annual basis. Mr. X must remain in the service till the end of loan, till the term of loan end, means they need to remain in the company till the loan is repaid. Mr. X remain in the service till the term, okay. The market rate of this comparable loan is given 12%. You can see market rate of interest is given, but once again there is no transaction cost. If there is no transaction cost, then EIR will be equal to what? Market rate of interest. If there is no transaction cost, EIR will be equal to what? Market rate of interest. Understood? Correct? Yes, Bharachanda. If the discounting factor is given the question, then use the discounting factor given the question, even though it is wrong. Correct now. You can't change the discounting factor given in the question. If the discounting factor is given in the question, use the factor given in the question. If the discounting factor is not given in the question, then I will say whatever factor you are taking. Suppose you are taking 3 decimal, 4 decimal, 5 decimal, 6 decimal, whatever you are taking, write down that decimal, whatever you are taking. Correct now. If you are taking 3 decimal, but you are multiplying with 4 decimal, that is not correct. If you are taking 3 decimal, write down 3 decimal, multiply with 3 decimal only. You are taking 4, then write down 4 decimal and multiply with 4 decimal only. Correct now. Got this point? Correct. I will say that my opinion is that take 3 decimal, or you can take 4 decimal also, your choice. Chalega? Understood. After financial instrument will start Ind AS 115. Guruji, samjhe? Correct. Now they have given following table show the contractually expected cash flow. Expected cash flow means what? Suppose they have given prepayment option, so of course we'll do some estimated cash flow. If suppose prepayment option is not available, so the first year they will repay 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh. Correct. Now first this repayment will be adjusted with 7% interest bearing. Correct now. So can you say first year what will be the interest? So 6 lakh ka 7% will calculate and 4 lakh ka 4% will calculate. Correct. Then second year, because 2 lakh is paid, so for 6 lakh 2 lakh has been paid, so 4 lakh is left. So 4 lakh into 7% and 4 lakh into 4%, then 2 lakh into 7% and 4 lakh into 4%. Then next year it will be 4 lakh ka 4%, because this has been repaid, and last it will be 2 lakh ka 4%. Can you see, even though this is not given, we can calculate it. So this become the estimated, this become what? Estimated contractual cash inflow. Correct. This become the estimated contractual cash inflow. Understood? Estimated contractual cash inflow. Got this point? Now Mr. S prepaid 2 lakh on 31st December 2002. Is on 31st December 2002 they are supposed to pay 2 lakh, but instead of 2 lakh they have paid 4 lakh. Understood? So prepay 2 lakh on 31st December 2002, reducing the outstanding principal as that date 4 lakh, because they have paid 2 lakh. They have paid 2 lakh, 4 lakh they have paid, means now the outstanding principal is only 4 lakh. Correct. Following the table, so the actual cash flow. Now they have given actual cash flow from the loan given to Mr. X, considering the prepayment event at the end of 31st December 2002. Okay, what is the actual cash flow? First year they have paid 2 lakh, then 42,000 and 6 now interest. Then they have paid 4 lakh. The interest was 28,000, 16,000 only. Then their outstanding principal is 2 lakh. That is paid as estimated. So 2 lakh. So it will be 4 lakh ka 4%. That is 16,000, then 2 lakh 8,000. So this is their actual cash flow, actual cash inflow. Understood? Yes, sir. Now, so can you say, because of that prepayment, there is some modification in the estimated cash flow. There is some modification in the estimated cash flow. So what we'll do in this case, that we need to understand. Have you understood this much? Question, have you understood? Bolo. Respond. Correct. Now can you say, first we'll find out the initial fair value of loan. Correct. Now in this question, understood that contractual rate of interest and the market rate of interest are different. Therefore the fair value of loan will be the present value of estimated contractual cash inflow on initial date. So you can see this become the contractual cash inflow. Initially will apply discounting factor at 12% market rate of interest, and this become present value. The difference amount means compare with 10 lakh. Difference amount is 1,56,121. This will be prepaid EB expense. Our first journal will what? Loan receivable account debit this much. Correct. Then prepaid EB expense account this much to what bank? This prepaid EB expense account will be amortized on equal basis for 5 year. Initially for 5 year, so divide by 3 karenge, so divide by 5 karenge. 1,56,121 divide by 5. So how much will be amortized every year? 31,224. So 31,224 will be amortized every year. And on this 8,43,878, can I say we apply amortized cost? Will apply amortized cost. Correct. Now you can see Now we need to find out amortized cost till the date of modification. The modification was done as on year end 2, as on year end 2. So it was the loan outstanding, correct? Now this format is thoda sa atpata format. I don't like this format. So loan outstanding, correct now, means 8,43,878. So can you say 8,43,878? Then we'll calculate interest at a rate of what? 8,43,878, interest at a rate of 12%, coming 1,01,265. Then contractual cash inflow. Contractual cash inflow was how much? It was 2 lakh. It was 2,58,000. Achha, they have done here. So they have done this minus this. Then this is the second year. I don't like this type of format. Correct now. So this is 2,58,000. So 2,58,000 minus करेंगे 2,58,000. So see how much? Minus 2,58,000. That will come 6,87,143. 143. Then it will be 6,87,143. Then again 12% you will do. That will come 82,000. 82,457. 457. Then what was the contractual cash inflow estimated? Means what was the contractual cash inflow? That was 2,44,000. But extra they have paid 2 lakh. So it will be 4,44,000. So you have actually paid 2,44,000. 2,44,000 plus 2 lakh plus 2 lakh. So can you say this become the original carrying amount? This become the original carrying amount minus 2,44,000 and minus 87,143 minus 82,000 minus. So your balance will come 3,25,600. This is the original carrying amount. Become the original carrying amount. So this become the original carrying amount. Now you'll find out revised carrying amount. So revised carrying amount, you need to find out the present value of remaining revised estimated contractual cash flow. So can you say now in year 3, year 3 and year 4 and year 5, these are the remaining contractual period. So here now you'll pay 2 lakh plus 16,000 and here 2 lakh plus 8,000 and this will be nil. Now find out the present value at original year. Present value at original year. Original year is nothing but 12%. So at 12%, this you can find out. So this will become what? The revised carrying amount. Now compare these. The revised carrying amount, how much it is have done. I am just not calculating. You can see the revised carrying amount they calculated 3,58,673. 3,58,673. It become 3,58,673. Now you can see this minus this will be adjusted with prepaid EB expense. So what is the adjustment? Batao, minus 3,58,673. So adjusted amount is 33,073. 33,073. So what journal entry will do? Means up to this journal entry you have done. Up to this journal entry you have done. Now one more journal entry you will do because your financial asset will be increased. Your financial asset will increase. So what journal entry will do? Loan receivable account debit to prepaid EB expense. Prepaid EB expense 33,073. 33,073 with the on the date of modification. On the date of modification. Understood? Have you understood this point? Once you have done this journal entry, then your revised carrying amount will become how much? 3,58,673. On this now calculate interest expense, interest income by applying original EIR. Then do the next 2 year journal entry. Understood? I hope you have understood this also. Any doubt? Have you understood this much? No, no. Listen, Eddie, what is your doubt now? You are saying about lease receivable. Lease receivable, our India's 116 say that your discount rate will be interest rate implicit on lease. Interest rate implicit on lease. Now this become what? This become EIR. Now they are saying lease receivable will be will be will be accounted by using amortized cost concept as per India's 109 by using this only. This only. So this become what? Original EIR. This become original EIR. Now on the data modification, use revised EIR. So revised EIR will be given the question. The revised EIR will be given the question. Okay. So don't worry about that revised EIR for modification. Revised EIR will be given the question. Right now, don't ask me, sir, what is revised EIR? The revised EIR for modification question in case of lease will be given in the question. Will be given in the question. Understood this point? Listen, Eddie, where is your doubt over? Yes, sir. Now, have you understood this question? I hope you have understood. Do this question. This question is also 1 second expected. Can be asked in exam. Already asked 2 times in exam. Already asked 2 times in exam. So do it 1 second by your own. This also done. Now come to the next concept. Up to this, any doubt? This much you understood. The next concept is financial liability at amortized cost. Financial liability at amortized cost. Once again, financial liability can be classified in two categories. Either it will be financial liability at FBTPL or financial liability at amortized cost. But normally they will not ask any question of financial liability at FBTPL. They are asking financial liability at FBTPL. That will be derivative instrument. Correct now. Normally they will ask financial liability at amortized cost. Once again, can you say here the contract are at off market terms or contract are at market terms. Now if the financial liability means if the financial liability is contract at off market terms, it is a question of compound finance instrument. So that is already done in concept number 1. Is if suppose they have given some instrument at off market terms from the point of view issuer, then it means it is a compound financial instrument. If suppose the debenture has been issued at off market term, it means it is compound financial instrument. It means it is a compound financial instrument. So this topic is already done in concept number 1. Means whenever they ask only financial liability from examination point of view, it will be always at market terms. It cannot be at off market terms, because if it is off market terms, then it become what? Compound financial instrument. So normally this question is always given at market terms. That is what this become concept number 5. So whenever financial liability has been given the question at amortized cost, so this will be always at market terms. At market terms means what? Contractual rate of interest and market rate of interest are same. So we are doing this concept because compound financial instrument is already covered in my concept number 1. First identify contractual rate of interest and calculate contractual cash outflow. Then since the contract are at market terms, this contract will be at market terms, so can you say the fair value of financial liability will be always equal to transaction price received. Whatever proceed you have received, that will be only the fair value of financial liability. Correct. Then identify transaction cost. In question they will give transaction cost, because can I say it is always market terms, so they will give transaction cost. Identify transaction cost and recognize financial liability at fair value minus transaction cost. Fair value minus transaction cost. Got this point? Fair value minus transaction cost. Then what generally will do? Bank account debit to financial liability with the net profit. With the net profit means what? Fair value minus transaction cost. Then identify ER. Of course, can I say if transaction cost is not given the question, then ER will be equal to market rate of interest. That will be equal to contractual rate of interest in this question, because these two are same. If the transaction cost is not given, so normally they will not ask this type of question. They will ask this type of question when the transaction cost will be given the question. In this case, ER will not be equal to market rate of interest. So ER will be given the question specifically. ER will be given the question specifically. Then calculate amortized cost by applying ER means opening liability interest by using EIR, and then contractual cash outflow. This will become closing liability. Understood? Have you understood? So one question of this nature is also given. Let me do that question also. That is not given an expected question. To come to that question. That question have been asked also. I think one time that question have been already asked. One time that question has been already asked in exam. You can see this question. The A Limited made a borrowing from RBC Bank of rupees 10,000 at a fixed interest of 12% per annum. Loan processing fee. Now you can see at 12%. Now in this question they have not given market rate of interest. You can see they have not given market rate of interest. Correct now. If they have not given market rate of interest, it means what? It means what? It means what? Contractual rate of interest and market rate of interest are same. Therefore, it is at market terms. It is at market terms. Now, loan processing fee means transaction cost is given. Means can I say ER will be different to ER was not given in the question, but in the exam question they have given ER will be 16.60, 16.60. So you can see in the exam question they have added this and they have given 16.60 as what EIR. Add EIR. The loan amount is 10,000. Date of loan is this. Date of finishing date means it is for 2 years, 31st March 2003. Repayment of loan start from 30th September 2001 to be paid half yearly. So 10,000 will be paid in 4 equal half year installment, 2,500, 2,500, 2,500, 2,500. Correct? Then installment amount 2,500, interest rate is 12%, interest charge. Interest to be charged on quarterly basis. On quarterly basis means interest you need to calculate and pay on quarterly basis. Correct? That means you need to calculate interest on quarterly basis. Correct? Upfront fees means transaction cost is what? 500. Now you only say in this case initial recognition will be done at fair value minus transaction cost. Fair value, because it is at market term, fair value will be equal to what? Transaction price received, that is 10,000 minus 500 transaction cost, it means 9,500. So initial recognition has been done at what? 9,500. Then we need to find out contractual cash outflow by using contractual rate of interest. So you can see they have calculated amount of interest quarterly 300, then 300, then 225, then 225, then 150, then 150, then 75, then 75, and the principal amount is paid on half yearly basis. Okay, this become the quarter 1 contractual cash outflow, this become quarter 2 contractual cash outflow, this become quarter 3 contractual cash outflow, this is the contractual cash outflow. Then you can use that table, the amortized cost table. I will say always use amortized cost table in this way. I always like this, and in exam don't follow ICA solution. They have given in the very I will say unnecessary format. So format is very simple. The opening liability interest at 16.60% per annum. This is per annum. So quarterly it will become 16.60 divided by 4. It means it becomes 4.15% per quarter. You can do it also. And then contractual cash outflow, then amortized cost. So quarter 1, what was the opening? 9,500. 9,500 into 4.15%. It will become 394. So you can add on 394. You can add on approximately 394, and the contractual cash outflow for first quarter was how much? Is 300. So 300 write down. So this plus minus this. So 9,500 plus 394 minus 300 is equal to how much? It is 9594. Then quarter 2 it will be 9594. Then it will be what? Into 4.15%. It will be 398 approximately. Then it will become 2,800, because principal also will be paid and interest will be also paid. Correct? So it will be plus equal to minus 1,800. It will be 7,192. So this way you can do for quarter 3, then quarter 4, then quarter 5, then quarter 6, then quarter 7, and then quarter 8. So this is first year, this is second year. Understood? Have you understood? Calculation. So always amortized cost table, use this format. In ICA they have given different format, that is thoda sa confusion. Use this format only in exam, but this fine. Chalega. So this also done. So I hope financial liability also done from examination point of view. Financial liability done. Any doubt? Then modification in financial liability. This is very important topic. From this also question may come. Now normally this is a topic of derecognition of financial liability. So whenever there is a derecognition, there are actually any financial liability can be derecognized either by payment, or by cancellation, or by exchange, or by modification. modification. So payment over simple is financial liability account debit to bank. Any difference will be transferred to PL. Cancellation means what? Financial liability account debit to PL. Entire amount will be cancelled. Exchange means what? It will be exchanged by equity share. So this I will discuss thoda sa, and then modification we are discussing. So we are discussing modification. So derecognition due to modification. Derecognition due to modification. So what India says that if the modified terms are substantially different from original term, then will follow extinguishment accounting, otherwise will follow modification accounting. So what they are saying, if the modified terms are substantially different from original term, if the modified terms are substantially different, bolo, if the modified terms are substantially different from original term, if yes, then will follow extinguishment accounting, otherwise will follow modification accounting. So follow extinguishment accounting means they have given one equation. If that equation is satisfied, then it means will follow extinguishment account. What is the equation? A minus B is more than or equal to 10% of B, and this amount A minus B will be taken in absolute amount. Absolute amount means what? Ignoring negative sign, means A minus B, if it is coming negative, so negative will be considered as positive amount. Then compare with 10% of B, then compare with 10% of B. So A minus B is more than equal to 10% B. So what is A, what is B, that we need to understand. A is equal to present value of modified cash flow, and any legal fee paid discounted by using original EIR, Got this point? Have you understood? The present value of modified cash flow and legal fee paid discounted by using original EIR. This will be A. Correct. Now this you compare with B. B will be the carrying amount of financial liability on the date of modification. Carrying amount of financial liability on the date of modification means what? Present means what? Amortized cost. It means amortized cost. To calculate amortized cost on the date of modification, can you say either you can calculate amortized cost on the date of modification, or we can say this is nothing but present value of remaining contractual cash flow and the original term discounted by using original EIR. So you can calculate in both way. Either you calculate amortized cost on the date of modification, or calculate present value of remaining contractual cash flow and the original term on the date of modification. By using original EIR. So you can see this is also original EIR, this is also original EIR. Then find out A minus B, and then find out 10% of B. 10% of B means 10% of B. If A minus B is more than or equal to 10% B, means extinguishment accounting, otherwise follow modification accounting. Have you understood? Debit reconstruction means what? Balachanda, what you are writing? Debt reconstruction means what? Yes, we are doing that only. This is not reconstruct, this is known as restructuring. We don't say reconstruction, we call it debt restructuring. Okay, correct? Have you understood this much? Now, if suppose the equation satisfied, then we'll follow extinguishment accounting. Extinguishment accounting means whenever a question of modification given, first you need to do this analysis. A minus B is more than equal to 10% of B. Then the test is passed, follow extinguishment accounting, otherwise follow modification accounting. However, in exam they will ask extinguishment accounting only. They will not ask modification accounting. They will ask extinguishment accounting. This is the only from exam point of view, this is only important, extinguishment accounting. Now whenever extinguishment accounting, so we need to find out to de-recognize old liability and recognize new liability. So first you need to find out fair value of new liability. The fair value of new liability will be the present value of modified contractual cash flow discounted by using market rate of interest on modification date. Now always whenever you are calculate fair value, you use market rate of interest on that particular date. So it becomes present value of modified contractual cash flow discounted by using market rate of interest on modification date. Understood this point? Now if suppose market rate of interest is not given, then we'll assume that modified terms are at market terms. Modification has been done at market terms, then modified contractual rate of interest will become market rate of interest. Understood? So if market rate of interest is not given in the question, modified terms are assumed to be at market terms, that is market rate of interest will be modified contractual rate of interest will be equal to modified contractual rate of interest. This point have you understood? Have you understood this point? Follow. Have you understood this point? Yes, sir. So once you calculate fair value of new liability, then find out gain on loss on derecognition of old liability. Then you compare fair value of new liability. In this, add any legal fee paid on the date of modification. The legal fee paid on the date of modification. On the date of modification. Now, whatever legal fee paid on the date of modification, this is not a transaction cost. A this is not transaction cost. This is not a transaction cost, because transaction cost is paid on contract date. Whenever you are paying any modification cost, means any legal fee paid due for modification, that is not a transaction cost. That is not a transaction cost. Be careful, that is not a transaction cost. Correct? So fair value of new liability plus legal fee paid. So okay, this is the total amount paid or payable due to modification. Compare with the carrying amount of old liability. This was actually payable as per the previous contract. Any extra amount you are paying, any less amount you are paying, that become gain or loss on derecognition of financial liability. If you are paying extra amount, that become loss. If you are paying less amount, that become gain due to modification. Correct? Understood? Yes, sir. So this is how to calculate gain or loss. Then pass this journal entry. Old liability account debit at carrying amount to new liability at fair value, to bank with the legal fee paid extra. The difference will be gain or loss, and this gain or loss will be transferred to PL, and then this new liability will be subsequently recognized at amortized cost by applying ER. And can I say ER will be equal to market rate of interest? Why? Because there is no transaction cost. There is no transaction cost on that date, on modification days. So applying ER, and in this ER will be equal to market rate of interest on modification date. On modification date. Understood? Have you understood this particular part? Have you understood this particular part? Follow. Have you understood this particular part? Respond fast. Respond fast. Can I take one question? Understood? I'm taking a good question only which was asked in exam, and where थोड़ा doubt आ सकता है, थोड़ा सा good question है, it is a good question. I'm taking that question only. Question is what? This is the question. Correct? Already asked in exam, can be once again repeated in exam. Will Company Limited borrowed how much? This is always be careful. This is 50 crore from a bank on 1st Jan 2001. The original terms of loan were as follow. Interest rate is 11%. So this become contractual rate of interest. Repayment of principal in 5 equal installment. Payment of interest annually on accrual basis. Upfront processing fee. This become transaction cost. Effective rate of interest is 11.5%. Why they have given effective rate of interest? Because there is a transaction cost. This question you only say what will be the market rate of interest. You only say whatever concept I have given, but what is the market rate of interest? Market rate of interest will be what? Let's see whether you have understood my emotions or not. Up to this we have read, but what is the market rate of interest for this particular borrowing? One question added. What? Which question newly added? Because in this concept, no question newly added. Which question you are saying about newly added? In modification, there is no new question which has been added. Added. Remember. Very good. Excellent. So can you say if nothing is given, market rate of interest will be equal to what? Contractual rate of interest. We'll assume this contract is at market terms. Contract is at market terms. Correct. Therefore, there is no need to calculate fair value of loan. Very good. Excellent. Table on. Here this question was given. Table on demand available. Just circulate me that question in my personal WhatsApp. I will just check it. Okay. I don't remember. मेरे दिमाग से चला गया होगा. Then on 31st December 2002, Will Company Limited approached the bank citing liquidity issue in meeting the cash flow required for immediate installment and renegotiated the terms of the loan with the bank as follow. For immediate cash flow required for immediate installment, interest rate is 15%. Repayment of outstanding principal in 10 equal installment. This is the modified terms. Payment of interest on an annual basis. Record journal entry in the books of Will Company Limited till 31st December 2000. This is the modification question. First, we need to analyze. First, let me explain the question. What they have given. Can you say on 1/1/2001, the proceed is what? 50 crore. Transaction cost is 5,87,000, 58,70,090. So this become the net amount. This become the net amount. Contractual rate of interest is 11%. Market rate of interest is 11%. Here they've given 11.5%. What is the original contractual cash outflow? So interest, can I say, because they have said 50 crore will be paid in 5 equal installment. So 10 crore, 10 crore, 10 crore, 10 crore, 10 crore. The interest will be on diminishing balance. The first interest will be 11% of 50 crore, 5.5, then 4.4, then 3.3, then 2.2, then 1.1. So this become the original contractual cash outflow. Original contractual cash outflow. Understood? Then modification date. This become modification date. Legal fee is not given in the question. No legal fee paid. This is no legal fee paid. So you need to also identify any legal fee paid on modification date. So no legal fee paid. Now they have given that that outstanding principal amount will be divided into outstanding principal amount. So on this date, can I say if this principal amount has been paid, so 40 lakh is outstanding. The 40 lakh outstanding will be repaid in 10 equal installment. So this become modified terms. So modified repayment of outstanding is what? 4 crore. Correct. Now in this question, what is the modified contractual rate of interest? Modified contractual rate of interest is 15%. They have given modified contractual rate of interest is 50%. Now once again, in this question, they have not given market rate of interest. Is they have not given market rate of interest on the date of modification. But what will assume? What will assume? Send me that question, Balachandra. Send me that question. I understood your question now, but send me that question. But in this, the market rate of interest was not given in the question on modification. Then we'll assume that modified terms are at market terms, and therefore market rate of interest will be also equal to what? 15%. Market rate of interest will be also equal to 15%. So this is very important. You need to identify what is required. So because this was not given, we have assumed that modified terms are at market terms. Therefore, market rate of interest will be equal to what? 15%. Understood this point? Understood this point. Now, first we'll do analysis of modified terms. Correct. Now, so we'll find out present value. Achha, one doubt will come. Just try to understand. They said that here the modification was done. Now the question is that on this modification date, this interest 4.4 will be assumed to be paid. It is also not paid. Because can I say they have not given anything about this point. If this 4.4 lakh is paid on modification date or is not paid on modification date. Are you getting what I am saying? This is to paid, this is paid. The modification done on this date. The question is silent about that. But what they have written, if you read the question carefully, they have negotiated in the meeting the cash flow required for immediate installment, and in this one, repayment of outstanding principal. So repayment of outstanding principal, it means, can you say interest was paid on that date, only principal amount was not paid. So from this we have concluded that bhai, this was paid but this was not paid, so your outstanding principal become 40 crore. 40 crore is now is supposed to be repaid in how many equal installment? 10 equal installment. So what is the modified cash flow? Modified cash flow is 4 crore, 4 crore, 4 crore, 4 crore for how many year? For how many year? 10 year. Understood? And then we have to calculate what? Interest also on this. Correct. So present value of contractual cash flow under modified terms and any legal fee paid discounted at original year. This will be a, so you need to find out for how many year? 10 year. 1, 2 means starting from 31st 12 2003. 10 year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10. So 4 crore is what? 4 crore is what? Your outstanding principal. The 4 crore, 4 crore, 4 crore, 4 crore, 4 crore written. Now you need to calculate 15% contractual interest based on modified terms. So it will be what? First year it will be 40 crore into 15%. So 40 crore 15%, it will be 6 crore. Then 40 में से गया minus 4, so it is 36 into 15%, that will become 5.4 crore. Then 36 minus 4, it will become 32. So 32 into 15%, it will become 4.8, and so on. So this become the modified. This become modified contractual cash flow. Modified contractual cash outflow. You can find out present value at original year. What is the original year? 11.5%. To find out present value, so this present value will come. Then this become present value of modified contractual cash outflow discounted by using original year. Then add legal fee paid in this. Legal fee paid is not given in this question. So this become what? Your A. This become A. Now I'll find out B. B is what? Amortized cost on modification date. Amortized cost of on modification means carrying amount of liability on modification date. So you need to find out amortized cost. So you can see we had an year 1 and year 2 because modification has been done in year 2. The opening liability was how much? What was the opening liability? Opening liability was this amount, 49 crore 41 lakh 29,904. So this become opening liability, the net amount. On this, interest is calculated at original year 11.50, then minus contractual cash outflow. The original contractual cash outflow was 5 crore plus 5.5 crore interest amount. So that is nothing but 15 crore 50 lakh, and this become the amortized cost of first year. Now this will come opening balance. Then once again interest will be calculated, but in second year we have paid only interest component. We have not paid principal component. So we have paid only 4 crore 40 lakh. 4 crore 40 lakh. So be careful about this point. This 4 crore 40 lakh only interest component has been paid. So this become the carrying amount of closing liability. Carrying amount of closing liability. Understood? Correct. So this become B. This become B. Now A minus B. So this is A minus B. A minus B is coming this, and 10% of B. 10% of B will be this. So you can see A minus B is greater than 10% of B. Therefore, we'll follow extinguishment accounting. Therefore, we'll follow extinguishment accounting. Got this point? Have you understood? Up to this, any doubt? Up to this, any doubt? Everyone respond fast. Now one doubt will come, sir, can we do by rounding off this amount in crore or lakhs? No. If the figure is given total amount, you also do in total amount. You can't do round off. Just try to understand. Rounding off means you are doing smart work. Become more smart now, they will give you smart marks. So just try to understand. They have given full amount. You also do calculation full amount only. Got this point? So because there are so much numbers are there. So this is the way of increasing the difficulty level. Now if you are rounding off in lakhs figure or crore figure, so you are doing smart work. Correct now? So they will give you smart marks only. Got this point? So I will say don't do the like that. It will not take much time. Be thoda concentrate karo. Speed badao. Correct? Understood? Now extinguishment accounting, we need to find out fair value of new liability. Fair value of new liability will be the present value of modified contractual cash flow discounted and market rate of interest. That is 15%. Now just try to understand, if the contractual rate of interest is modified contractual rate of interest and market rate of interest are same, then there is no need to calculate it. Can you see this will be equal to 40 lakh only? Is if you find out the present value of this at 15%, so this will be 40 lakh only. This is a common sense. Is compounding आपने अगर if you have done, if you are adding interest at 15%, so discount at 15% will be same nominal amount, correct? Now 40, this will be 40 crore only. So you can see without calculation I have written 40 crore. This is smart, this is what is smart work now, because you know this point, so there is no need to once again calculate it. Understood. The present value of modified contractual cash flow discounted at market rate of interest is 15%, because in this question market rate of interest was not given. So we have assumed that modified contractual rate of interest and market rate of interest are same. Then gain or loss will calculate. So what is your new liability? 40 crore. What was your old liability? Already be calculated in previous working note. So this will be the gain or loss. Then you can do what? Journal entry. Journal entry आप देख लो, in this solution they have given journal entry. Just do the journal entry by your own. Understood? Have you understood? I hope you have understood. Got this point? Any doubt? So this modification also over from my point of view. However, there is one more concept in this. What is that concept? If there is a modification accounting, means if the modified terms are not substantially different from original terms, then we follow modification accounting. However, from my point of view, they will not ask any question on this. But if they ask, don't blame me. Correct now. So I will just only read it. What IND AS 101 is actually silent about the accounting treatment for this modification accounting. Therefore, ICA has given two approach. ICA has given two approach. Alternative one. From my point of view, if the question has given, follow alternative one in exam, because ICA has also in study matter they have follow approach number one, but they have given two approach one and approach two. Whenever they suppose the equation is not satisfied, the equation is failed, then we have to follow modification accounting. They in this they will not do any de-recognition of all liability. We only will what do some modification in that original liability. Whatever legal fee paid will be considered as payment of liability. So we'll pass one journal entry financial liability account debit to bank with the legal fee paid. Correct. Then we'll compute revised EIR. We'll compute revised EIR. However, it is quite possible revised EIR might be given in the question. So we need to compute revised EIR. That will be the rate of interest at which present value of modified contractual cash outflow should be equal to adjusted liability. Adjusted liability means after deducting the legal fee paid, whatever amount left, that become adjusted liability. You need to find out rate of interest at which present value of modified contractual cash outflow should be equal to adjusted liability. Then by using this revised EIR, prepare one amortized cost table by applying revised EIR. This is one approach. Second approach is easy. Second approach is more easier. In this case, whatever legal fee paid will be recognized as an expense immediately. Whatever legal fee paid will be recognized as an expense immediately and transferred to PL. Then we need to restate liability, means we need to find out the revised carrying amount of liability. Revised carrying amount of liability will be present value of modified contractual cash flow discounted by using original EIR. To find out present value of modified contractual cash flow discounted by using original EIR, this becomes revised carrying amount liability. Now compare revised liability with the carrying amount of original liability. The difference will be transferred to PL. Difference will be transferred to PL. Correct now. This is more easy. I will say more easy, but you can follow approach one, follow approach one, otherwise follow approach two, because both suggestion is given by ICA only. Then in this case, prepare amortized cost table by using revised liability by using original EIR. By using original EIR, to prepare amortized cost table by applying original EIR on revised liability. You can do it. You can do it. Correct now. So suppose they ask any question on this, so you can do it. Understood? Have you understood this? Correct. This concept also done. Correct. Now let us come to the next concept. Next concept is what? About impairment of financial asset. Impairment of financial asset. Impairment of financial asset. Up to this, whether revision is going okay? Are you able to follow everything? Correct now. If you are able to follow everything, just press the like button. Just press the like button. Okay, because your more and more like will always bring smile on our face. Up to this whatever I have done, whether you are able to revise everything, whether everything is coming in your mind, whether this revision is helpful or not. Fast, I'm taking 2 minute rest. Chalo. So let us start one more concept. Concept number 7, impairment of financial asset. Okay, I'm expecting one question of impairment this time. It might come in exam. However, from exam point, I'll say they have given 5 to 6 the study matter. Do all the question for this concept. They will, from my point of, they will not create any new question. Whatever question they have given, just do it by your own. Okay, na? But what is the concept? Because this is real concept, but I am just teaching you from examination point of view. So impairment of financial asset. What are the financial assets which are covered in this topic? So coverage is what in this topic means we do impairment of financial assets, but not for all financial assets. In this we cover debt instrument measured at amortized cost. Only debt instrument which are measured at amortized cost will be covered. Then debt instrument which are measured at FBTUCI will be covered. And lease receivable will be also covered. So what Ind AS 1 say that for impairment of lease receivable, go to what Ind AS 109. So lease receivable will be also impaired as per Ind AS 109. However, not covered. Debt instrument which are measured at FBTPL will not be covered. Equity instrument which are measured at FBTPL or FBTOCI will not be covered. Correct. And derivative instrument will not be covered. So these are outside the scope of this topic. This topic I am saying not from this chapter. So these are not, this will not be tested for impairment. However, this will be tested for impairment whenever there is an indicator. Whenever there is a indicator. Correct. Now, so whenever the question say that the entity is facing financial difficulty, the debtor is facing financial difficulty, it means it is a question of what impairment. In this, first calculate carrying amount of financial asset on the date of impairment. So can you say this is nothing but present value, this is nothing but amortized cost by applying original EIR. So first calculate the carrying amount of financial asset on the impairment testing date. This is nothing but amortized cost by applying original EIR, or you can calculate present value of remaining contractual cash flow under original term as per original term discounted by original EIR. Both will give same answer. You can use amortized cost table because that is more easy, but if you want to shortcut, you can use shortcut present value of remaining contractual cash flow on impairment date discounted by original EIR. Then find out calculation, then calculate present value of expected contractual cash inflow. Expected contractual cash inflow to be recovered discounted by using original EIR only, original EIR. So expected contractual cash inflow can be recovered. So that will be given that now we are expecting that this can be recovered from the debtor. So find out a present value of expected contractual cash inflow to be recovered discounted by using original EIR. Correct. Now, so can you say this will become the new carrying amount, revised carrying amount. Correct. And the difference between these two will be no. The difference between A minus B is known as expected credit loss. Expected credit loss. Expected credit loss will be A minus B. Expected credit loss will be A minus B. Understood? Now, what Ind AS 109 says that we need to find out this is expected credit loss. credit loss. So ECL means what? Expected credit loss. But expected credit loss will not be the amount of allowance. Amount of allowance on your doubtful debtor, or we call it impairment loss, will be based on 12-month or lifetime ECL measurement. So it means we need to find out whether we need to apply 12-month ECL or lifetime ECL. This will be given the question whether 12-month ECL or lifetime ECL will be given the question. Means either they will give this or they will give this. Both they will not give. Correct now. So in that case, we need to find a probability of default in case of 12-month ECL or probability of default in case of lifetime ECL. So that probability of default will be given in the question. So then it will be ECL multiplied by probability of default by using 12-month or lifetime as per the information given in the question. So once you multiply with probability default, that will become the allowance for bad and doubtful debt, or we can call it what? Credit loss allowance, or we can call it impairment loss. All are same name. Is whether we call it allowance for bad and doubtful debt, or we call it credit loss allowance, or we call it impairment loss, all are same name, all are same, correct? Interchangeable word. So but don't use the word provision for doubtful debt, that is bakwas term. Correct now. Use allowance for bad on doubtful debt, or credit loss allowance, or impairment loss, whatever name you want to use. Correct now. But if the probability of default is not given now, the probability of default is not given, always assume 100% from examination point of view. So if the probability of default is not given, then always assume 100% from examination point of view. Understood? Have you understood? Correct. There are two good questions. Let me take one by one each question. First come to question 56. On 1st April 2001, entity granted an interest-free loan. The contractual rate of interest is 5 lakh to an employee for a period of 3 years. The market rate of interest is 5%. Means this is subsidized loan. Correct now. Means of course the difference will come and difference will be transferred to prepaid EB expense. On 31st March 2003, because of financial difficulty, this is an indication of what? Impairment. The employee asks to extend the interest-free loan for a further 3 years. They want to extend it to further 3 years. So initially it was 3 years. Out of 3 years, how much expired? On 31st March 2002, to 2 year expired, 1 year left. They want to extend it to further 3 years. So for the remaining new term will be what? 4 years. The entity agreed. Under the restructured term, repayment will take place on 31st March 2007. You can see 3 plus 4 means initially it was 31st March 2003 means 2 year expired, extended by 3 plus 1 more. But just try to understand. This is the original term. This was 1/4/2001. This is 2. This is 3, 4. So we are standing here. They want to increase by further 3 years. So of course it will be extended by 4 years now. Remaining year is what? 4 years. Understood. Therefore they have given 31st March 2007. However, the entity only expect to receive a payment of rupees 2,50,000 given the financial difficulty of employee. So now they are expecting only 2,50,000. Initially the amount was 5 lakh, but now the negotiated amount is only 2,50,000. Explain the accounting treatment on initial recognition loan. The initial recognition you can do it. This is subsidized loan. Correct now. You will find out the present value of the contractual cash inflow. Contractual cash inflow will be nothing but only, because it's 0%, so only 5 lakh will be received after 3 years. So you will do what? Present value of 5 lakh. Present value of 5 lakh at market rate of 5% will be, I think, around, it will come 4,30,200. Calculate. Understood now. So this will 4,32,200. Difference will be what? Difference will be 68,000. This will be accounted as prepaid EB expense. So first general entry they have done loan receivable account, prepaid EB expense account to bank. Understood? This will be amortized in how many years? This will be amortized in how many years? 3 years as per the given contractual term, and this on this will apply amortized cost table. So we need to now find out carrying amount as on impairment date. So carrying amount as on impairment, this means as on year end 2 will find out. So this will become amortized cost at year end 2, become amortized cost at year end 2, correct. Now we'll find out the present value of estimated contractual cash flow, correct, now to be recovered from the debtor, correct. Now so that is what 2,50,000 we receive, but after 4 years we'll find out present value of that. So 2,50,000 discounted by using original EIR. Original EIR is 5% because there was no transaction cost to EIR, and market rate of interest will be same. So original EIR will be 5% only. 2,50,000. The present value of estimated cash flow is calculated to be 2,05,750 by using original EIR of 5%. So that is only they have calculated 2,05,750. So amortized cost is what? 4,67,280, and this become what? The present value of estimated amount to recover. What is the difference? Difference kitna hua? 4,76,280 minus 2,05,750 is equal to what? 2,70,530. So this become easier. This become easier. Now probability of default is not given. So whenever probability of default is not given, we'll assume 100%. So they have not calculated in that way. But suppose probability default is given, you multiply by probability default, that become impairment loss. But if it's not given, it become 100%. It become 100%. I hope you have understood. It become 100%. Therefore impairment loss is this. Then pass one journal entry, impairment loss account debit to financial asset. So you can see impairment loss account debit to financial asset. This journal entry has been done, and your revised carrying amount will be equal to 2,05,750. And you can see now they have done the new amortized cost table based on 2,05,750 discounted by using interest at 5% only, means original year, and then they have calculated this amortized cost, means to amortized cost. Understood? This question I am expecting. This can be one expected question. Good question, I will say. One more question is there. An entity purchased a debt instrument with fair value of rupees 1,000 on 15 March 2001 and measure the debt instrument at FBTOCI. So I have already said the debt instrument at FBTOCI will be also tested for impairment. So debt instrument which are measured at FBTOCI will be also tested for impairment. The instrument has an interest rate of 5% over the contractual term of 10 years and has an effective interest rate of 5%. This can is the contractual rate of interest and ER are same. Therefore, can you say interest payment and interest income will be, interest received, whatever interest received and interest income will be same only because contractual rate of interest and effective rate of interest are same. Therefore, opening balance and closing balance will be same. So this is also one shortcut. Whenever contractual rate of interest and ER are same, then opening balance and closing balance of that financial asset or financial liability will be always same. Opening balance and closing balance of that financial asset or financial liability will be always same. At initial recognition, the entity determined that asset is not a purchase or original credit impaired asset. This is Bakwas point. On 31st March 2001, the fair value of debt instrument has decreased to 950. So fair value has decreased. So first we'll find out carrying amount by doing fair value accounting. So their subsequent measurement of this type of instrument will be done at fair value. So what is the fair value loss? 950. As a result of changes in the market interest rate, the entity determined that there has not been significant increase in the credit risk since initial recognition, and the ECL means expected credit loss should be measured at an amount equal to 12 month. So 12 month ECL. So they have given which amount to rupees 30, means they have given 30 is the impairment loss, means 30 impairment loss has been given. Correct now. 30 impairment loss has been given in the question. I hope you have understood. On 1st April 2001, means next date, the entity decided to sell the debt instrument for 950, which is the fair value on that date past journal entry. The first journal entry will what? Financial asset account debit to bank on initial recognition. It was purchased on 15th March. 15th March. Now they have asked you to pass journal entry. Journal entry, ignoring interest income, is relating to interest income are not to be provided. Why they have said? Because can I say once again, the interest received and interest income both are same. So even though you are passing that journal entry, that will not affect the closing balance. I hope you're understanding. So can you say this journal entry, if you want to pass that journal entry pass for 15 months, you can for 15 days you can calculate interest income by applying EIR, correct, but ignore because they have said ignore. Now on 31st March, we are coming to on 31st March. First we'll do fair value gain and loss. There is a 50 rupees loss, but out of 50 rupees, 30 is impairment loss. 30 is impairment loss. So impairment loss will be transferred to PL. Correct now. So what journal entry will do? Impairment loss 30 and fair value loss is 20 out of that 50. So this loss will be transferred to OCI and accumulated in FBOCI reserve. And impairment loss will be debited to PL. Understood? This is the meaning. Have you understood? Impairment loss will be transferred to PL. Out of total loss, we will reclassify impairment loss to PL. And the balance will remain in OCI. The balance will remain in OCI. I hope you have understood this. To financial asset 50 at this point. Now, on the next date, means on 1st of next year, this was sold at fair value. The carrying amount is 950 only. We will pass journal entry bank account debit to financial asset 950. Once the asset is de-recognized, then accumulated loss in FBOC reserve will be reclassified from OCI to PL. So that journal entry has been done. They have done one compound journal. They have not done compound journal entry. So we have done reclassification loss on sale to OCI and FBOCI reserve will be also credited. So 20. So with this, what will happen? FBOCI reserve will become 0 and it will be reclassified from OCI to PL. Understood this point? So this is also one good question which have been given in ICS study matter, can be asked in exam. There are 2-3 more questions given, that is totally super easy question that you do by your own. Understood? Impairment also done from my point. Then coming to derivative instrument. Derivative instrument, only one question they have given. Now derivative are of two types. One is held for trading, one is held for hedging. So held for hedging, the accounting will be totally different. Held for trading, the accounting is very easy. So held for trading, it is always measured at FBTPL. So derivative instrument which are held for trading will be measured FBTPL. So initial accounting will be, initial recognition will be done at fair value. Subsequent recognition will be also done at fair value. Understood? And any gain or loss will be transferred to PL. Any gain or loss will be transferred to PL. Understood? Let me take one question. Only one question of this nature has been given that can be asked in exam. This is the question. On 1st Jain 2001, same company agreed to purchase $20,000 from JT Bank future on 31st December 2001 for rate equal to 68 per US dollar. 68 is a forward rate. The forward rate. I know you know about future, you know about forward contract, you know about option. You know about option, correct now. However, in ICS study matter, they have not given any question on option. Whatever question they have given, the question is related to forward contract or future, correct now. So we are also discussing future accounting only. Same company limited did not pay any amount upon entering into the contract. No consideration was paid initially. So the initial value of this forward contract means future contract will be 0. So initial fair value will be 0. Same company limited is a listed company in India and prepares financial statement on a quarterly basis. Means there are 4 quarterly reporting date. So a subsequent recognition will be done at each quarter ending. Following the principle of Ind AS 109, you are required to record the entries for each quarter end till the date of actual purchase. Now, whenever there is a derivative instrument, either it can be net settled in cash or it can be physically settled. Physically settled means we will go for actual purchase, actual sale of underlying asset. So here underlying asset is what? Foreign currency, that is US dollar. So they want to actually purchase that. Nothing is given, so we'll do net settlement in cash. Net settlement in cash. For the purpose of accounting, they have given the fair value of forward contract. So can you see initially on 1st Jan 2001, the fair value was nil. Then on 31st March, it become negative 25,000. Negative 25,000 means the situation is unfavorable. Then on 30th June, it becomes 15,000 negative. Means the situation is unfavorable only. Means there is an obligation to pay 15,000. 30th September, it become positive, means it become asset. So the situation become favorable. And on 31st December, means settlement date, the rate is 66. Now the contract was done at 68. Now the spot rate becomes 66. Means can I say it is also unfavorable? Unfavorable means you need to purchase it at higher price, 68. However, the market price become 66. So what is the unfavorable? Is 2 rupees, we can say 2 rupees into 20,000. So can I say on this date the fair value of forward contract become negative 40,000, become negative 40,000. So this is the entire thing. Correct. Now so you can see initially 0, initially no journal entry will be done. On 31st March, can I say the liability become 25,000. So there is a loss of what? Loss of 25,000. Then 25,000 become 15,000. So there is a gain. So liability decreases. So the gain of 10,000. Then 15,000 become positive 12,000. 15,000 liability become asset of 12,000. So can I say there is a gain? Gain of what? 15 plus 12, 27,000. 27,000, and then again it become negative. So 12,000 positive become 40,000 negative. So once again there is a loss of what? 52,000. This point have you understood? Have you understood this point? Have you understood this point? Up to this. So then according to this we'll pass journal entry. You can see on 1st Jan no journal entry. You write on no journal entry as no consideration was paid. On 31st March, we'll do one journal entry, profit and loss account debit to derivative financial liability. So you can add on fair value loss, transfer to PL to derivative financial liability. Then there's a gain, so liability will decrease, so we'll do derivative financial liability to fair value gain, transfer to PL. Correct. Then derivative financial liability become derivative financial asset. So liability will decrease, asset will increase. So derivative financial liability 15,000. Derivative financial liability 15,000 will decrease, and we recognize derivative financial asset of 12,000. Derivative financial asset of 12,000 to fair value gain 27,000. Correct. Then again on 31st December, can I say the liability become asset become liability. So we'll recognize asset and recognize liability. So fair value loss account debit to derivative financial asset 12,000 to derivative financial liability 40,000, and the loss will be of 52,000. Understood? Correct. So however they have given one compound journal entry, so for you can pass 2 journal entry instead of this. I'm giving that 2 journal entry. They have given compound journal entry. I will say pass 2 journal entry on the settlement date. It will be fair value loss of 52,000, derivative financial asset 12,000, and to derivative financial liability 40,000. This is the first journal entry. Then you need to purchase dollar, so you will purchase dollar. How much dollar? $20,000. What is the spot rate? 66. 20,000 in 66 will become 13 lakh 20,000, and you will pay rupees. How much you will pay as per the contract? Contractual amount is 68. Pay 20,000 into 68. Pay 13 lakh 1,000, and you can see there was a derivative financial liability which will be now debited. Derivative financial liability debited, that is 40,000, and entire derivative account will be closed. Automatically it will be closed. You can pass this separate journal entry. However, I think they have given one compound journal entry. You can see they have given one compound journal entry. Ultimately the effect remains same. However, the loss is what? 52,000. Our loss is also 52,000. Understood? Have you understood? However, suppose in the question they have said they are not going for actual purchase, they want to do net settlement in cash, so only this liability will be paid. Then we'll pass one generate derivative financial liability account debit to bank, and 40,000 will be paid. 40,000 will be paid. Correct. If the question is silent, then always will do net settlement in cash. Got this point? This also done. This also got this point. Understood? Understood. You can see all the topic whatever is given in this summary note done. Now there are some topic. One is what? One topic which is important is hedge accounting. Then is one concept of financial guarantee. And there is one concept of embedded derivative. There are three small topic from which also question may come. From hedge accounting, they have given only one question that can come. Till now not asked in exam. From financial guarantee, they have given one question. This is already asked in exam. Embedded derivative, they have given two type of question that is not yet asked in exam. Let us do these three topics. So all the questions will cover. Concept, there are small concept that you will do by your own. This MCQ question can be based on small concept. Means already I have covered that, but you need to read once the entire content. So only these three topics are left. Can we do these three topics also? Follow fast. Follow. Now, hedge accounting में there are two topics. One is known as fair value hedge. One is known as cash flow hedge. Now, fair value hedge, they have not given any question. Cash flow hedge, they have given one question. So I will say cash flow hedge, that question will only do. Only I will take that question. That question I will explain. That question I will explain. Chalega? Follow. Yes or no? So cash flow hedge, they have given one question. Now, whenever fair value hedge means what? Whenever, abhi I am not explaining everything. I will take only one question. Chalega? Cash flow hedge. I am taking only one topic, the question, because they will ask this question only. They will not create any new question from my point of view. Let us take that question. This is the question. Question 60. Beside construction activity, Building and Company Limited is also engaged in the trading of copper. So it means Building and Company is engaged in trading of copper. On 1st April 2001, it had 100 kg of copper costing rupees 70 per kg, totaling rupees 7,000. So they have some inventory whose cost price is 7,000. The company has a scheduled delivery of this 100 kg of copper to its customer on 30th September 2001. They have already done one commitment to sell. They have done one commitment to sell this copper at 100, to sell this copper at first $100 on that date. Whenever, just try to understand, there are three topics actually. There is already recognized asset and liability. For this we use fair value hedge accounting. This might be important for MCQ. There is some firm commitment. Firm commitment means execute contract. Contract done, but that will be done in future. Commitment has been given that I will purchase or I will sell this much right now. Firm commitment. Option has been given. Either you can use fair value hedge accounting or you can use cash flow hedge accounting. An option has been given. Either fair value hedging or cash flow hedging. And if there is an expected transaction, expected, highly probable transaction, highly probable transaction, then we use always cash flow hedge. Understood? Correct? Are you getting what I am saying? This can be important for MCQs. So for recognized assets and liability, if you are taking some hedging instrument, then we use fair value hedge accounting. If there is any firm commitment, then and you are hedging that, then we'll use either fair value hedge or cash flow hedge as the option given. There is some expected highly probable transaction, then we'll always go for cash flow hedge. Understood? You can see they have done some commitment. They have a scheduled delivery of 100 kg of copper on 30th September 2001 at a rate equal to $100 on that date. So either we can use fair value hedging or cash flow hedging. So what I will do, I will explain both fair value hedging as well as cash flow hedging. However, in this question they have said we are supposed to use cash flow hedge accounting. It is given the question. Where it is given? It is given. We read the question. To protect itself from a decline in the currency exchange rate. Now some dollar will be received. So if dollar receive and there is a decline in the dollar rate, so there is a risk, and therefore they want to cover that risk by taking some hedging instrument. Right now, to protect itself from decline in the currency exchange rate, the entity hedges its position by entering into currency future contract for equivalent currency unit at 76 per US dollar. So they have entered into a forward contract to sell $100 at 76. So this is what a forward contract to sell $100 at 76 per dollar. So this become a forward rate. This become a forward rate. The future contract mature on 30th September 2001. This contract was done on 1st April 2001, but will be settled on 30th September 2001. Means after how many months? 6 months. The management performed an assessment of hedge effectiveness and concluded that hedging relationship qualify for cash flow hedge accounting. So it is given that will follow cash flow hedge accounting. Cash flow hedge accounting. However, the same question can be also solved by using fair value hedge accounting also. The entity determined then document that changes in fair value of currency future contract will be highly effective in offsetting the variability in cash flow of currency exchange. On 30th September 2001, entity closes out its currency future contract. On the same date, it also sell the inventory of copper at US dollar when the spot rate was how much? 72. You are required to pass journal this read. Assume that exchange rate are as follow. The exchange rate is given as follow and 6% is the discount rate. Why discount rate is given, that we need to understand. Correct now. First April 2001 it was 76. So these are forward rate given. Forward rate 30th June, this is future price. Future price means forward rate. Forward rate is what? 74, and on 30th September forward rate is 71. This is the entire question. Question have you understood? Question have you understood? I'd like to explain this question. Let's try to understand. What they have given? 1st April 2001, then 30th June 2001, and 30th September 2001. So they are preparing a quarterly financial statement. These are what? Reporting date. Correct. Now they have entered. They have a inventory. How much inventory they have? 100 kg at 100 kg. The total cost is 7,000, and they have a expectation, means they have done one contract to sell inventory on 30th September at 100 US dollar, and to offset the risk they enter into forward contract to sell $100 at 76 per US dollar. Now they have given forward rate. Here the forward rate is 76. Here the forward rate becomes 74. Here the forward rate become 72. 71, sorry. 71. Yes. 71. And then they have given one spot rate. Spot rate is given 72. However, from my point of view, question is not correct. On this date, spot rate and forward rate will be always same. On this date, spot rate and forward rate will be always same. So from my point of view, the question is not correct. But let us assume as it is, and we'll go as per the question given to be information diya hua hai, that only we'll consider. Got this point? Yes, sir. This is the entire question. Now, can you say first we need to find out fair value of forward contract? We need to find out fair value of forward contract. Just try to understand. 76, you have enter into a contract to sell at 76. Correct now? Now it becomes 74. But it is favorable situation, unfavorable situation. It is favorable situation. Why? Because you can sell at 76. However, the rate becomes 74. So you can sell at higher price. Correct now. So this is favorable situation. This is also favorable situation. So we need to find out fair value of forward contract. Initially it will be nil. Then it becomes 76 minus 74. 2 into 100. That becomes 200. And here it become 5 into 100. That is equal to 500. Correct. So can you say, just try to understand. This is the fair value of forward contract, which is receivable after 6 months. This is receivable after 3 months. This is receivable after 0 months. We need to find out present value. Present value find out karna hai. So we'll use discount rate that is given 6% per annum. So 6% per annum divided by 4. So can it become 1.5 per quarter? Per quarter, the rate of discount will be 1.5 per quarter. So can you give me the discount factor? It will be 1.015 divide equal to. So can you say for this it will be 1 because 0 1. For this it will become 0.985 and for this it will become 0.971. Now multiply this. So what is the fair value of forward contract? This is 500. This is 200 into 0.985. This become 197 and this become 0. This become 0. So this become the fair value of forward contract. Correct. So what will be the gain or loss? What will be gain or loss? So here gain or loss is nil. Here gain or loss is what? Here gain is 197. Here the gain is what? Gain is 303. So this will be accounted. This will be accounted. Have you understood this calculation? This calculation you have understood? This calculation you have understood? Have you understood? Now suppose the discount rate was not given now, then your fair value of forward contract will be this 0, 200 and 500. Whenever discount rate is given means the time value of money is matter here, it means you need to discount it and this will become fair value of forward contract. But if the discount rate is not given, then your fair value of forward contract will be 0, 200 and 500. Understood? I think this point you have already done in your AFM. This point have you understood? Everyone follow. I'm assuming that derivative concept you know from AFM, so I'm not going into detailed concept of derivative. You know about favorable, unfavorable, this all situation you know. Up to this any doubt? Then we'll come to journal entry. One 136 not. This is 6 month, this is 3 month, this is 0 month, not 1 month. Because just try to understand that it will be settled, the contract will be settled after 6 months. Na? Means whatever this is favor, this is receivable after 6 months, this is receivable after 3 months, and this is receivable after 0 month. Therefore this become 0, this become 3, this become 6 months. So it means you need to discount. This is discounting for what? 0 month. This will become y0, then it will become y1, then become y2. Understood what I am saying? Correct? Got this point? Yes, sir. Hello. I hope you haven't. Correct? Now let us do accounting. The first journal entry on 1/4/2001 is no journal entry. Because can you say there was no transaction done and the fair value of forward contract is also 0. Then on 30th April, on 30th June, what is the fair value of forward contract? 197. So there is a gain of what? 197. Will pass one journal entry. Derivative financial asset, account debit, fair value gain, which will be transferred to PL. 197. 97. But what cash flow has says will not be transferred to PL. This will be transferred to OCI. So the transaction will actually sell the asset on, will sell the inventory on settlement date. Correct now? Therefore, you need to wait for transfer to PL. So you will accumulate this in OCI. You will transfer it to OCI and accumulate in cash flow hedge reserve. So this will be accumulated in cash flow hedge reserve. I mean fair value hedge accounting now. You transfer to PL immediately. This is the difference between fair value hedge and what? Fair value hedge and cash flow hedge. This is the actual difference. Understood this point? Correct. Now, on 30th September, once again there is a gain. Derivative financial asset will increase by 303, and once again this will be accumulated in cash flow as 303. Correct. Now they have given in the question that on the settlement date derivative will settle. So how much amount we receive? Amount received will be 500 from derivative contract. We receive what? 500 from derivative contract. And on this date we'll sell the inventory. So what journal entry will do? Either we'll say bank or receivable account debit to revenue, and it has been sold at $100. What is the spot rate? Spot rate is 70. Spot rate is what? 72. We'll do into 72. It becomes 7,200. 7,200. This much you understood. Now what we'll do about that cash flow has reserve? What India's 109 says that whenever it is cash flow hedge, and if this cash flow hedging is resulting in a financial asset or financial liability, you can see they are resulting in a financial asset or financial liability, then that accumulated gain or loss will be transferred, reclassified to PL. What we'll do? We'll pass one journal entry, OCI cash flow has reserve will be reclassified from OCI to PL and will be transferred to revenue. How much? It will be transferred to revenue. However, if suppose this transaction, this cash flow hedging transaction result in a non-financial asset or non-financial liability, suppose there is some machinery or etc., then this cash flow hedge reserve will be removed and adjusted with the carrying amount of that non-financial asset or non-financial liability. That will not be reclassified to PL. So this is the concept. Concept have you understood? Concept you have understood? Have you understood this particular point? I think only one question. This question will come rat low score. This question you do rectification if you have not understood, because same to same question will come if they will ask in exam. Got this point? So from my point of view, hedging also completed. Hedging also completed. Now come to embedded derivative. Come to embedded derivative. There are two questions. Both questions are expected, and therefore both questions I have taken also. I have taken both questions. I have taken only one question. One question I will take from book. Acha, taken. I have taken both questions. Both questions I have taken in expectation. Embedded derivative is expected from my point of view. But till now no question have been asked in this. Now there are two type of question. Embedded derivative means what? When a derivative instrument is inserted in a non-derivative host contract, that is known as embedded derivative. So there will be some host contract which is non-derivative contract. In that some derivative will be embedded. That will become a hybrid contract. Embedded derivative is a component of hybrid contract in which the derivative is inserted in a non-derivative host contract. Understood? What our India's 32 says that we should separate that embedded derivative. Now how, when to separate, when not to separate, that I am not discussing. So whenever a question will come for embedded derivative, we need to separate in exam. There are some condition. If that condition is not satisfied, will not separate also. Now only one thing you know, separation will be done only in the books of issuer. It will not be done in the books of holder. Correct now? Means separation will be done in the books of the entity which is recognizing financial liability or equity instrument. Who have issued that instrument, they will separate it. If it is in the books of holder, correct now, then will not separate it. For example, let me take one question. G Limited issued callable preference shares to G Limited. Because preference share is a non-derivative host contract. In this one option has been inserted, call option has been inserted. Chalega? For a consideration of 10 lakh, the holder has an option to convert his preference shares to a fixed number of equity instrument of the issuer at any time to a period of 3 years. If the option is not exercised by the holder, the preference shares are redeemable at the end of 3rd year. The preference share carry a coupon RBI base rate of 1%. Now at the end they have given RBI base rate is 9%. This can I say 9 plus 1, 10% become contractual rate of interest. Contractual rate. So can I say it is nothing but callable, optionally convertible preference shares. Optionally convertible preference share is a compound financial instrument. So we already have done separation in the books of issuer. We never do separation in the books of holder. So embedded derivative will be also separated always in the books of issuer, not in the books of holder. This point have you understood? Correct? Yes, sir. So call option is what? Call option is what? Derivative. And optionally convertible preference shares is a non-derivative host contract. The prevailing market rate of interest they have given. How much they have given? 4%. RBI base rate plus 4%. It become 9 plus 4, 13%. Correct? Understood? The value of call option. The value of call option will be always given the question. Why it will be given the question? Because that is calculated as per AFM subject. Correct? Now, they will not ask you to calculate value of call option. The value of call option determined by Black and Scholes model. They have given 29165. Now, always whenever these type of questions come, I am just giving one formula. That formula you need to apply. So proceed is equal to, here is a fair value of compound financial instrument minus fair value of call option. This is the formula. Understood? Just try to understand. When suppose I am holding call option, so holder will pay consideration. So always holder. So here the entity who has issued that instrument is holding that call option. Means they have a right to buy back. They have a right to redeem that preference shares. So right to redeem I have. So I become the holder. So I will pay consideration. For compound financial instrument, we have received consideration, and for the call option will pay consideration. So this become a net amount. The net amount is 10 lakh. Understood? And this fair value of compound financial instrument is nothing but fair value of liability component that you can calculate plus fair value of what? Equity component. This is a question mark. We need to calculate it minus fair value of call option. This become one formula. Now, the equation become 10 lakh. Okay, this fair value of liability component you can calculate. This is nothing but present value of contractual cash or discounted by using market rate of interest. That you can calculate. That is already calculated in this. So that is this plus this. How much it is coming? 6,93,050 plus 2,36,115. It is coming 9,29,165. So 9,29,165. You can calculate it. Plus this become question mark x minus fair value of question. This is given 29,165. This is given. If you solve it, so you will get it. Fair value of equity component will be equal to 1 lakh if you solve it. So this is the answer. Have you understood this point? Correct. Have you understood this point? So this can be one question. So this you need to calculate by using the same concept of compound financial instrument. Got this point? I hope you have understood. Chale aage. This is one question. Second question is what? Is they have given in ICS study matter. This time they have given in MTP also. However, in every MTP they are giving that question, but they have not yet asked in exam. So this is also one question which is probable. What happens? Suppose, what is this question? Suppose there are two companies, A and B, and they have functional currency, suppose rupees, and they have done some transaction, suppose purchase transaction or sale transaction, that has been done in dollar. So what IND AS 109 says that because this transaction has been done in dollar, so there is some embedded derivative to buy or sell dollar. So that need to be separated. But this currency are different from this transaction currency. Correct. Now suppose this is what? Rupees. This is euro. And they have done transaction in dollar. Then this also will have embedded derivative. But suppose this is rupees. This is euro. And they have done in euro. So this does not have any embedded derivative. Because of course the transaction can be done in any one entity's functional currency. That is what genuine transaction. But here there are some adjustment done they want to say, and they want to separate it. Correct. Now, so this is one question. Let me take the question. Now you'll understand. Company A, an Indian company whose functional currency is rupees, enter into a contract to purchase machinery from unrelated local supplier company B. The functional currency of company B is also rupees. However, the contract is denominated in dollar. Since the machinery is sourced by company B from US based supplier, payment is due to company B on delivery of the machine. Key terms of the contract. Understood? The key terms is given. Contract that is 9 September. Delivery payment that is 31st December. Purchase price is what? Means they want to purchase the machinery in $10 lakh. Then they have given forward rate on 9 September 67.8. Then they give spot rate on 9 September 66.4. Then they have forward rate On 30th September, this is reporting date 67.5, and 31st December, they have given spot rate. These are the information given. Company is required to analyze if the contract for purchase of machinery from company B contain an embedded derivative. You say yes, it contain an embedded derivative. We need to separate it. Whether they should be separately accounted. Yes, it should be separately accounted as per Ind AS 109. Also give necessary journal entry. So how to pass journal entry, that I am explaining right now. Have you understood the question? Question, have you understood? Follow. Question, have you understood? Yes, sir. So, chalo, let us do it. I'll just explain it. What is this? This is 9th September, then 30th September, then 31st. They have given forward rate. Forward rate is how much given? First is given 67.8. Then spot rate is given how much? They have given spot rate 6.4. Then they have given 30th September. Forward rate is 67.5. Then they have given spot rate on 31st is 67. On this date, forward rate will be 67 equal to this. Now, we are doing this question from A company point of view. So, A company has two contracts. First contract is what? Purchase machinery in rupees. In rupees. What will that rupees amount? That will be equal to 10 lakh dollar multiplied by forward rate 67.8. So what IND AS 109 say that actually they have entered into contract to purchase machinery in rupees only, has denominated in dollar. So of course can I say there is an expectation to purchase machinery at 10 lakh into 67.8 means it is rupees 678 lakhs. Second, just try to understand, when you purchase machinery, do you pay dollar? It means you are selling dollar. If you are paying dollar, means you are selling dollar now. Correct? If you are giving dollar, it means there is the intention to sell dollar. So second is what? Forward contract to sell 10 lakh dollar at forward rate. Forward rate is 67.8. These are the two contracts. This is derivative contract and this is non-derivative contract. Understood? Have you understood? So we have separated it. Now we'll pass journal entry based on this. Correct? Now first, on 9th September, can you say no journal entry? Because the fair value of forward contract will be 0. So in this case, no journal entry. Then on 30th September, what they want to say? This 67.8 becomes 67.5. So there is a agreement, there is a forward contract sale 10 lakh dollar. You can see 67.8 becomes 67.5. It is a favorable situation because now even though the forward rate decreases, you can sell at 67.8. Yes or no? So there is a gain of how much? There is a fair value how much? It is 0.3. 0.3 into 10 lakh. Into 10 lakh. It become how much? 3 lakh. So 3 lakh become gain. Yes, sir. What journal entry will do? Derivative, financial asset to fair value gain transfer to PL 3 lakh. We'll pass journal entry with 3 lakh. Similarly, once again on 31st December, it becomes 67. Once again favorable. So it becomes 0.8 into 10 lakh. It become 8 lakh. So now there is fair value of forward contract is 8 lakh. So now 3 lakh become 8 lakh. Once again there is a gain of 5 lakh. What journal entry will do? On 31st December, once again, derivative financial asset, account debit, 5 lakh, to PL, 5 lakh. You can see now derivative financial asset automatically become 8 lakh. But gain is what? 3 lakh for the first quarter and then 5 lakh for the second quarter. Got this point? Now we'll do actual purchase of what? Machinery. So, what journal entry? Now we'll do machinery. Account debit. Can I say 2 payable? to payable, and we have done one contract to purchase machinery at 678 lakh. So we'll do 678 lakh. 678 lakh. Correct. Understood? Are we ready? So just try to understand. In this contract, we have a receivable of 8 lakh from that supplier, and we have a payable of 678 lakh. So what our TS 109 is saying that now do set of this payable with this receivable. What journal entry will do? Payable will decrease by 8 lakh, and derivative financial asset de-recognize 8 lakh. Ultimately, you are paying 670. So now the payment will be done. Payable account debit 670 to bank 670 means ultimately you are paying as per the spot rate, and you can see the spot rate was 67. So you are paying ultimately at spot rate only. This is the entire journal entry. Have you understood the entire journal entry? This is one question which can be asked. Similar question can be asked in exam, because this type of question has been given in MTP also. Got this point? Got this point? Now suppose this question has been asked from B company point of view. In B company there will be two contracts. One will be to sell machinery in rupees, that is 678 lakhs, and to buy dollar. To buy, if this is sale, this will be always buy. Not low. Correct now. Here only student do mistake. So 10 lakh dollar at 7.8. Understood? So these are from B company point of view, it will be reverse. To sell machinery in Indian currency and to buy dollar in what? To buy 10 lakh dollar at 67.8. So they can also ask from B's company's point of view also, but in this question they have asked from A's company's point. Have you understood now? But this also embedded derivative concept also done. Now let us come to the last topic. That is what? Financial guarantee. So I am taking that question only, financial guarantee question. Only one question they have given. Similar question have been also asked in exam. So with that question, I have covered all the concept from which they are asking question. Actually. This question is not given in my expected question, but I am doing that. Suppose they ask, so you should be able to do it. What they have given? On 1st April 2021, Fortunate Bank has provided a loan of 25 lakh to Mohan Limited for 4 years at 10% per annum. And the loan, this question was asked in exam for 12 marks. And the loan has been guaranteed by Surya Limited, which is, so I am taking here because this is, I am taking this question, okay. Can do by roll. This is ICS study matter question. On 1st April 2001, Sun Limited guarantee 10 lakh loan of subsidiary to Sun Limited guarantee 10 lakh loan of subsidiary Moon Limited, which bank STDK has provided to Moon Limited for 3 years at 8%. So Sun Limited is a parent company who has given a guarantee on behalf of subsidiary company to a bank. So this is known as financial guarantee. Guarantee, you understood? Interest payment are made at the end of each year, and the principal is repaid at the end of loan term. The Sun Limited had not issued a guarantee, bank STDK would have charged Moon Limited an interest rate of 11%. But if the guarantee was not given, then the rate of interest would have been 11%. This 11% is the market rate of interest from subsidiary company point of view. If the guarantee was not given, then bank would have charged 11% for subsidiary company. Yes, sir. Sun Limited did not charge Moon Limited for providing guarantee. The Sun Limited, because they are related party, they have not charged anything for guarantee. But can you say there will be one fair value of guarantee? But IND AS 109 says that we need to find out a fair value of guarantee, which is nothing but present value of differential cash flow by comparing that two rate of interest. Is if the loan would have been given at 11% and the loan was actually given at 8%, what is the differential cash flow? Present value of that differential cash flow will be the fair value of guarantee. Means the benefit of subsidiary company is the fair value of guarantee. Correct now. So we need to first calculate fair value of guarantee. You can see first we have calculated cash flow, based on 11%. Understood? Then we have calculate cash flow based on 8%. Then this is the differential cash flow. Then we'll find out present value at market rate of interest, that is 11% from subsidiary company's point of view. 11%, correct? 11%. Be careful about this. Then this becomes the total present value. This is the fair value guarantee. Then we'll pass one journal entry in the books of Sun Limited. Investment account debit to finance the guarantee obligation. One liability will be created with a investment account, because this is just like an investment done in the books in the equity shares of subsidiary company, because they have not asked any compensation for this. Suppose some amount is receivable, so we would have done receivable account debit to finance a guarantee obligation, correct? Now with the same amount, suppose this is compensated by subsidiary company, suppose 50% compensated, so we'll do receivable account debit 50%, investment account debit to 50% to finance the guarantee obligation 100%. Understood? Correct. Now this will be subsequently recognized at a higher of what India's 109 says. This will be subsequently recognized at a higher of 2 amount. Higher of 2 amount means an amount of loss allowance or amortized cost, whichever is higher. So first we need to calculate amortized cost. So amortized cost table will prepare. So this is what 73,320. We'll calculate interest at 11% minus benefit provided. Benefit provided means that differential cash flow. That is the benefit provided. This will become amortized cost. This will become amortized cost. This is first year amortized cost. This is second year amortized cost. This is third year amortized cost. Understood? Have you understood this point? Correct. Now at every year end, we need to also find out loss allowance. That will depend upon the information given in the question. So what is given, check karenge. What is given in the question? On 31st March 2002, there is a 1% probability that Moon Limited may default on the loan in the next 12 months. So this is 12-month ECL. If the Moon Limited default the loan, Sun Limited does not expect to recover any amount from Moon Limited. This will be always given the question. Don't ask me any other thing right now. Correct now. So it will be 1% of loan amount. So it become 10,000. So 10,000 become what? The loss allowance. And what is the amortized cost? Amortized cost is what? It is what? 51,385. So the subsequent recognition will be done at this amount or 10,000, whichever is higher. So this amount is higher. So subsequent liability amount will be 51,385. Initial amount was how much? 73,320. So your liability will decrease. That will become a gain. That gain will be transferred to PL. So your liability will decrease to this amount. So this amount is what? Dekho, how much? 73,320. 73,320 minus what? Minus 51,385 is equal to what? 21,935. So they have passed one journal entry. Financial guarantee decrease to PL. Understood? Correct. Then we'll come to second year. Second year mein aate hain. Second year mein what they have given. Now the probability default is 3%. 3%. So 3% 10 lakh. Now it become 30,000. Once again on 31st March 2003, we'll compare the loss allowance 30,000 with amortized cost. Amortized cost already we calculated 27,037 or 30,000, whichever higher. So 30,000 is higher. So now the liability will become 30,000 in the next year. So now the previous year liability was 51,385. Now it becomes 30,000. Once again liability decreases. So what is decreases? 51,385 minus 30,000 is equal to what? 21,385. This will be also transferred to PL. So what journal entry they have given? Financial guarantee account debit to PL with 21,385. 21,385. The last year will depend upon actual situation, whether default happen or default not happen. If there is no default, the liability will become 0. Then entire liability account will be transferred to PL. If there is a default, so they need to pay 10 lakh plus outstanding interest amount. So your liability will increase to that amount payable, and that will be also transferred to loss. But they have not given any information about last year. So your accounting is only up to 31st March 2003. So they have asked only up to 31st March 2003. Got this point? Have you understood? So this question can be also asked in exam. I hope you have understood. Correct. Now balance all question whatever is given and expected to by your own. I hope I have done my job. Now balance question you can do by your own. You can understand because all the concept we have done. All the concept we have done. Understood? This question number 1, you do it by your own. Correct. Now good question, but you will be able to understand. Question number 4, this also do by your own. This is also a good question. You can do it by your own. Almost I have done. This is also simple. I think compound finance instrument question is there. Do it by your own. Share option means this share option they have given. You can also write down equity instrument of this. All other question I have done. So this one question. This one concept about what compound finance is. If suppose there is some amendment in the terms to convince or to induce the holder for early repayment or early conversion, there may be some amendment in terms. But they are saying if there is some amendment in the compound finance instrument, so any additional fair value of consideration given that will be transferred to PL. I'm just taking one question. This can be asked in MCQ. On 1st Jan 1999, NTDA issued 10% convertible debenture with a face value of rupees 1000 maturing on 31st December 2008. The debentures is convertible into equity shares of entity at a conversion price of 25 per share. This what was the terms, original terms, the 1000 divided by 25. So how many shares will be issued? 40 shares will be issued. Was original term. Interest payable half yearly in cash at the date of issue would have issued a non-convertible debt at 11%. So if they ask the accounting of compound finance instrument, that you can do it, that I am not explaining. On 1st Jan 2006 is after some year, to induce the holder to convert the convertible debenture promptly, NTDA reduced the conversion price. Now they have reduced the conversion price. So now it become 1000 divided by 20 is 50 equity shares. So now they will issue 50 equity shares. The debenture is converted before 1st March 2006. The market price of entities equity shares on the date of terms are amended is 40. What is the additional equity shares provided? 10. 10 into what is the fair value? 40. It means 400. So what our IND AS 1096, that this fair value of additional consideration given will be transferred to PL. So this will be transferred to PL. That is only given. If how will the revised terms be accounted? So this will be a MCQ based question. You can see they have done that only. So 400 will be transferred to what? PL. So this value of incremental equity share issued upon conversion, just write down, it will be transferred to PL. Be transferred to PL. 400. Understood? Got this point? Also, question was asked in MTP till now, not asked in exam. Can be asked in exam. Now someone was saying one question. What was the question? Have you posted? I have not received that question in my WhatsApp. But which question you are saying? Payable on demand when the funds are available. I think you are saying this question, kya? Just see na. Are you saying about this? The loan is repayable on demand. This question. What was this? Balachandra, are you available? Are you asking me this question? This question or similar question also we have, or you might be asking this question. Follow. If you have done sir, you have written means okay. Then if you have done okay, I think it's a very easy question. You can read and understand by your own. Follow. Are you asking this question? Fast. Not done. My job has been done. Have you understood everything? I think financial instrument has been done. Now do all the remaining questions wherever you think that this question should be done. Is you have initially have written that this question is good question, that question also you do it. So you don't know because it's very vast chapter. Any question can be asked. Any question at any moment can be asked. And then just read once the content. Content एक बार read कर लो. Fast read कर देना. There's no need to mug up anything. What is fine? Follow. Parachandra, I am waiting for your answer. Reply. You may ask. You may be asking about this KK limited as granted because both are similar question. Both are similar question. चलो तो my job done. I hope you have understood all the things. Now, okay. So we'll take some break. Take almost 1 hour break and then we'll start Ind AS 115. चलेगा? Ind AS 115 will start. Break 1 hour. Meet at 3 p.m. After that we'll do Ind AS 115. Okay. Okay, sir. Ind AS 115. You want a revision of concept or question? You want a revision of concept or only expected question? बताओ. Because both will take a lot of time. You want only concept to be revised or you want me to do expected questions only? Follow. Just answer this point. You want me to revise concept or both? Concept plus important question. Arey baap. It will take a lot of time, Ray. Chalo, we'll take break. After that, we'll decide. I think only question chalega. Only question if you are doing. From question will take concept. Whatever question is there, I will just give a reference of concept also. The question. Okay, sir. Okay. We'll take a break. After break, we'll meet. Hello, hello. Hello. Yes, everyone. Yeah. Can we start again? Everyone? I mean, what you have asked, how much weightage can we expected from amendments, sir? There are two chapters which are newly added. One is professional and ethical duty. From that, one question of 6 marks will come. Then that is person pakka, one question will come. Then there is one chapter accounting and technology. From that, maximum 4 marks question may come. However, we are expecting 2 marks, 2 marks MCQ question only. But if they ask a theory question, that can be of 4 marks. Got this? Yes, sir. Yes, sir. Now, can we start revenue from contract with customer in AS 115? This will be my last chapter for revision. The other chapters you need to complete by your own. Okay, sir. Now, this is a chapter where I think that, of course, the revision should be done by you only, because this chapter requires the revision of content. Now, if you have done the question only, but if you can't write the content, because this type of chapters require understanding of content, because in exam you need to also write on content and then express your feeling about the question given, then you need to do the solving of that part. Got this point? Content revision is also required. Am I right or not? Let us start in AS 115. So of course, any revenue means what? Revenue means any income from ordinary activities are revenue. All incomes are not revenue, but all revenues are income. So any income which is not revenue will be shown under other income of SOPL. Now this chapter, this Ind AS 115 has given 5-step model for recognition revenue. First step is what? Identify the contract with revenue. Second is what? Identify the performance obligation in the contract. Then determine the transaction price. Then allocation of transaction price to to all the performance obligation. Then last will be recognition revenue as and when performance obligation is satisfied. The first step was identify the contract with revenue. So there are 5 criteria which we need to satisfy for identification of any contract. Means a contract will become the contract will become accounting contract in this chapter when the 5 condition is satisfied. First, the parties have approved the contract and committed to perform the performance obligation. Then second, to perform their respective obligation. The second, the entity can identify the parties right regarding the goods and services which has been transferred. The third is condition is what the entity can identify the terms of payment. The fourth point is what the contract must have commercial substance. It must have commercial substance. The last point is that it is probable that entity will collect substantially all the consideration which they are expected to receive from that particular contract. Correct? Now the 5 conditions, can you repeat with me? First is what the party have approved the contract. Then entity can identify the parties right regarding the goods and services to be transferred. Then entity can identify the payment terms. Then contract has commercial substance, and it is probable that substantially all of the consideration can be collected. All these conditions satisfied, then we move to step number 2. Otherwise we remain in step number 1 only. Now just try to understand. Sometime what happens, consideration received and the contract has not satisfied all the condition. In that case, what IND AS 115 say that consideration received will be recognized as liability. However, sometimes consideration received can be recognized revenue even though all the condition has not been satisfied in 2 circumstances. First circumstance is that entity's performance obligation is completed and the consideration whatever received is non-refundable. Performance obligation is satisfied and the consideration whatever received is non-refundable, then we can recognize the consideration received as revenue. Second, if the contract has been terminated, the contract has been cancelled and the consideration received is non-refundable, then also we can recognize the consideration received as revenue. Got this point? Then there is one point about combining the contract. What do you mean by combining the contract? 2 or more than 2 contract can be considered a single contract. Can be considered a single contract means we can apply IND AS 115 in total contract as a single contract if any one of the following conditions are satisfied. Is first, that 2 or more than 2 contract has been entered either at or near the same time, and which satisfy any one of the following conditions. First condition is what? The contract are negotiated as a package with a single commercial substance, means they are negotiated as a single package. Okay. Second point is what? The amount of consideration paid in one contract depend upon the price or performance of other contract. Correct. The third point, the goods or services promised in one contract, the goods or service promised in the contract are actually part of single performance obligation. Then we can combine the contract. This can be one important question. Means till now do not ask any question based on this, but they can ask a MCQ based on this question whether we can combine or we cannot combine. Understood? Yes sir. Then contract modification is important from exam point of view. What IND AS 115 says that if there is a modification in the contract, then it will be a separate contract or not a separate contract. If separate contract, then apply IND AS 115 separately. If it is not a separate contract, then we will do some adjustment in the original contract accounting. Correct. So when it will be separate contract, if 2 conditions are satisfied, the scope of the contract increases by addition of promised goods or services that are distinct, and the price in the contract increases by an amount which commensurate with the standalone selling price of added goods and services. These 2 conditions are satisfied, means the scope of the contract increases by addition of some additional goods and services that are distinct, and the price in the contract also increases, which is actually equal to the standalone selling price of additional goods and services. Then it will be separate contract, then apply IND AS 115 separately. However, if any one or both the conditions are not satisfied, then it is not a separate contract. In that case, 2 circumstances may arise. The remaining goods and services are distinct from the goods and services already transferred. The remaining goods and services are distinct from the goods and services already transferred, then it will be termination of old contract and creation of new contract. In that case, whatever transaction price till now not recognized, whatever transaction price which are not recognized, which is not recognized revenue, that will be allocated to remaining, is will allocate the remaining transaction price not yet recognized the outstanding performance obligation, to the outstanding performance obligation. It will result in termination of existing contract, termination of existing contract and creation of new contract. Understood this point? Termination of existing contract and creation of new contract, and whatever transaction price which is not yet recognized will be allocated to the outstanding performance obligation. Outstanding performance obligation. This can be one important question. One question we have in this. Just read this point. This is a similar question. Entity AB enter into 3-year service contract with a customer CD Limited. Come to expected question. For rupees 4,50,000, that is 1,50,000 per year. 3-year service contract. The standalone selling price of 1 year service at inception contract is 1,50,000 per year. The standalone selling price is also same. AB account for the contract as a series of distinct services. This is a series of distinct services. At the beginning of third year, the party agreed to modify the contract as follow. The fees for the third year is reduced 1,20,000. So first year, second year revenue has been recognized. Correct now, 1,50,000 per year. Third year, 1,50,000 become 1,20,000. And CD also agreed to extend the contract for another 3 years for rupees 3 lakh, that is 1 lakh per year. The standalone selling price of 1 year service at the time of modification is rupees 1,20,000. Well, the standalone selling price of 1 year of service at the time of modification is 1,20,000. But for extended period, you can see they are charging only 1 lakh. How should AB Limited account for the modification? So can you say in this case, can you say there is increase in the scope, we can say, because the term has been increased, but the price does not increase with the standalone selling price, because the price you can see it is 1 lakh, but their commensurate standalone price is 1,20,000. Therefore second condition is not satisfied, therefore it is not a separate contract. And in this case, the remaining goods and services to be provided are distinct from the goods and services already transferred. You can see it is already given AB account for the contract as series of distinct services. The remaining goods and services to be transferred are distinct from the goods and services already transferred. Therefore it will be termination of old contract, creation of new contract, and whatever the transaction price which is not yet recognized. So what is not recognized? 1,20,000 is the transaction price for the third year, new transaction price, and 1 lakh into 3 means 3 lakh for the extended period. So it becomes 4,20,000. This 4,20,000 will be recognized over the period of time, means you will do divide by 4. It means it will be recognized as a revenue 1,05,000 per year. So we recognize revenue as 1,05,000 per year. Understood? I hope you have understood this point. Have you understood? Correct? Yes, sir. Comment. Next point is what? If the remaining goods and services are not distinct from the goods or services transferred, is the remaining goods and services whatever you are transferring are not distinct from the goods and services already transferred, then in this case will account for the modification as if it were a part of existing contract. As if this is an existing contract, and what will do, the revenue, the amount of revenue will be adjusted on a cumulative catch-up basis. To adjust the amount of revenue on a cumulative catch-up basis. We'll take one question for this also. Let me take one question for this. We have one question for this also. This type of question can be asked. It can be asked in MCQs also, MCQ format. What is point? This question: Growth Limited enter into an arrangement with a customer for infrastructure outsourcing deal. Based on the experience, Growth Limited determined that customizing the infrastructure will take approximately 200 hours in total to complete the project, and the charges was 150 per hour. So the total hours to be taken will be 200, and per hour they will charge 150 per hour. After incurring 100 hours of time, Growth Limited and the customer agree to change the aspect, means modification of the project, and increase the estimate of labor hour by 50 hours at a rate of 100 per hour. Can you see in this? So there is no additional goods and services, means the scope has not increased. There is no increase in the scope, correct now, because only the number of hours has been increased, means same project, the number of hour has been increased. scope has not been increased. I hope you have understood. Therefore, it is also not a separate contract. And can I say the remaining goods and services transferred are not distinct from the goods and services already transferred. Therefore, the modification will be considered. The modification will be considered as a part of existing contract, and revenue need to be adjusted on a cumulative catch-up basis. Then, in this case, what we'll do? What was the original hour? 200. Then rate per hour was 150. Total become 30,000. Then modification was 50 hours more. The rate was 100. The total become 5,000. Means total hour become 250. This become total 35,000. It means the rate per hour become 35,000 divided by 250. So it will be 140 per hour. So it will be 140 per hour. But can I say till now we have already completed 100 hours. Means for the 100 hours we have already recognized revenue based on 150. So 100 hour already we have recognized revenue based on 150. Means 15,000 we have recognized, but we should recognize based on 140 hour. So 100 into 140 will be 14,000. Therefore we should reduce the revenue by 1,000. We should reduce the revenue by 1,000. We should reduce the revenue by 1,000. Understood this point? Have you understood this point? Correct. So this is what modification. I hope you have understood. 2 questions we have done. 2 questions we have done. Follow. Any doubt? Have you understood this particular point? Hello. This is one more question, but that we'll do at the end. Then second step is what? Identification of performance obligation. So performance obligation, of course we need to identify whether there is one performance obligation or there are 2 or more than 2 performance obligation. So performance obligation is distinct, then it will be a separate performance obligation. Means goods and services, they are distinct from other goods and services. Then we'll say that these are 2 different performance obligation. Understood? Correct. So there are 2-step model to identify whether the goods and services are distinct or not distinct. First step is what? We need to focus on whether the goods and services are capable of being distinct, whether they are capable of being distinct or they are distinct within. And second step is what? They must be distinct within the context of contract also. They are capable of being distinct. They are capable of being distinct, and they should be distinct within the context of contract. These are 2 steps. Whenever questions come about performance obligation, first you need to identify whether they are capable of being distinct. Means, what do you mean by this? The customer can benefit either by alone from that goods or by other readily available resources from the market. Means if the customer can use that goods alone or with some other readily available resources in the market, it means it is capable of being distinct. Correct? Understood? Second word, it must be also distinct within the context of contract. It must be also distinct within the context of contract. Correct? Now, so what IND AS 115 says that 2 or more than means the contract to transfer one goods and services will be distinct from other goods and services if the following conditions are satisfied. The following conditions are satisfied. First is what? Significant integration services not provided. Means one goods and services is not integrated with other goods and services. Means significant integration services is not provided. Second, no significant modification or customization. Means one goods or services is not used to modify or customize the other goods and services. Correct? Third, not highly interrelated or interdependent. Means one goods or services are not highly interdependent or interrelated to other goods and services. It means they are distinct goods and services. It means there are 2 or more than 2 performance obligations. So can I say in this way, the promise to transfer one goods or services will not be distinct. Means will be same performance obligation if the entity provides significant integration services, or if one of goods or services modify or customize the other goods or services, or if the goods are highly interrelated or dependent to each other, then it will be a single performance obligation. Then it will not be a multiple performance obligation. Understood? So this can be one question to identify whether there is one performance obligation or there are two or more than two performance obligation. Got this point? Yes, sir. Correct. So this is what theoretical type of point you need to understand from the question given the question, the information given the question to identify whether it is one performance obligation or more than one performance obligation. Correct? Yes, sir. Then step number 3 is what determine the transaction price. Now to determine the transaction price, there can be either fixed consideration or there can be some variable consideration. If there is a variable consideration, then we need to estimate the variable consideration. Then we need to estimate the variable consideration. How to estimate the variable consideration? It is as simple as what we have done under IND AS 37. So what IND AS 115 says that if the entity has a large number of contract with similar characteristics, then variable consideration will be expected value, and expected value will be the weighted average of all possible outcome given, all possible consideration amount. So that will be given the question to find out weighted average, that will become the amount of variable consideration. However, if the contract has only two possible outcome, then the variable consideration will be the most likely amount consideration, most likely amount of consideration, that is single most likely amount of the contract. Correct? And then what is the most likely amount that is given? Suppose they have given two outcome, 80% is this amount, 20% this amount. So 80% is this amount, that become the most likely amount, that become the variable consideration. Understood? Correct. This will be done as per the information given the question. I will take one question based on this, but I hope you have understood this particular point. Correct. Now, however, can you say we need to reassess the variable consideration at the end of each year? We do reassessment of the variable consideration at the end of each year. So reassessment is required. Correct. Now, so for that I will take one question which is already asked in exam. Come to this question. They are giving an entity has a fixed fee contract for 1 million, develop a product that meet the specified performance criteria. Okay, this is a fixed consideration. Estimated cost to complete a contract is 9,50,000. The cost to complete is 9,50,000. The entity will transfer control of the product for 5 years. The entity use the cost to cost input method to progress the contract. So this is actually the how to recognize the revenue. So I hope you know step number 5. So they have used cost to cost method, input method. An incentive award is available. The product meet the following weight criteria. You can see they have given some weighted average possible outcome. Is we need to find out weighted average of all possible outcome. 951 is greater 0%, so no incentive. 701 to 950 10%. 1 lakh is the incentive. 700 or less 25%. 2,50,000 incentive. Then they have given the entity has an extensive experience creating product that meet the specific performance criteria. Based on its experience, the entity has identified 5 engineering alternative that will achieve 10% incentive and 2 that will achieve 25% incentive. Is 5 out of is they have done as per their experience, but they are saying entity has identified 5 engineering alternative is saying that they will achieve 10% incentive and 2 are saying that they will achieve 25% incentive. This can I say it is what? Now only 2 possible outcome is there, either 10% or 25%. In this case, the entity determined that 95% confidence that they will achieve 10% and they are 20% confidence they will achieve 25%. So there are 2 possible outcomes. Therefore, most likely outcome will become the variable consideration. So in this case, most likely outcome is 10%. Therefore, 1 lakh will be the variable consideration. Correct? Now therefore the total transaction price will become 10 lakh plus 1 lakh. This para you read. Correct? Now then entity reassesses its production status quarterly, determine whether it is on track to meet the criteria for incentive award. At the end of year 4, some reassessment has been done. It become apparent that the contract will fully achieve the weight based criteria. Therefore entity receive its revise its estimate of variable consideration to include the entire 25% incentive fee. At the end of 4th year, now they are of the opinion that 25% incentive will be received. So can you say now we need to reassess the variable consideration from 1 lakh to 2,50,000. Understood? This is reassessment of transaction price. They have given that below the impact of changes in the variable consideration when the cost incurred. Now they have given actual cost incurred. For this point, now if you know step number 5, step number 5 says that we need to recognize revenue either at a particular point of time, yeah, over the period of time. So of course this is over the period of time, and we need to recognize revenue over the period of time by using input method, and one of the input method is given is cost to cost method. So we are also doing step number 5 also यहाँ पर चलेगा. In this case, how to perform this? बताओ. In this case, what is the fixed consideration? 10 lakh, and estimated cost to complete 9,50,000. So you can see total estimated variable consideration. First year 1 lakh, second year 1 lakh, third year 1 lakh, fourth year it will be 2,50,000, fifth year it will be 2,50,000. Understood? Fixed revenue and variable revenue. So we need to allocate fixed revenue and variable revenue by on what basis? So can you say by using cost to cost method? So you can see the actual cost given. देखो cost is given 50,000, 1,70,000, 4 lakh, 2,70,000, 50,000. This is the actual cost. So we need to use the cost to cost method to recognize revenue by multiplying by 50,000 divided by 9,50,000 divided by 9,50,000. So you can see the fixed consideration is what, 10 lakh. So 10 lakh into what? We'll do 10 lakh into 50,000 divide by 9,50,000. Similarly, 1 lakh into 50,000 divide by 9 lakh divide by 9,50,000. Same way we'll do in this way. So this will get the answer. I hope this allocation you have understood. This allocation you have understood. Just calculate, you will get the same amount. But can you say in the fourth year there were some changes? So you need to do some changes on cumulative catch-up basis. To apply cumulative catch-up basis, so how to apply cumulative catch-up basis, that we need to understand. Correct now? Because can you say first year, second year, third year, you have allocated transaction price only on the basis of 1 lakh. But in the fourth year, you have done allocation of variable consideration based on what? 2,50,000. So of course, first year, second year, third year, you have not done some allocation of variable consideration. This should be 2,50,000. So for that reason, we'll do some cumulative catch-up adjustment. So what they are saying, updated variable consideration what? 2,50,000. Correct? And have you understood this point? Have you understood this point? Follow. And cumulative cost up to year 4 is 9 lakh. Up to year 4, how much cost has been incurred? 9 lakh. The total cost is 9,50,000. Is approximately, can I say, 95% of work has been performed. 95 means this by this into 100. It is 95% approximately work has been performed. Means you should allocate how much? 2,50,000 into 95% will come this much. But how much you have allocated till now? You have allocated only how much? Are you able to understand what I am saying? The cumulative variable revenue through year 4. Just try it. But they are saying 2,50,000 into 95%. Is this should be, we should recognize 2,37,500 at this point. But we have recognized only how much? We have recognized this total. Just make a total of this. How much it is coming? 5263 plus 18421 plus 42105 plus 72368. It is coming 1,38,157. Means it is coming 157, but they have written rounding of 130. Means how much they have not recognized. Minus कर दो 2,37,500, 99,340 means 370 approximately. They have not recognized, so that will be also recognized in the year 4. That will be also recognized in year 4. This is what one way. So this become the total revenue. This become total revenue. Total revenue. From total revenue, if you minus total cost, so you will get profit margin. Then they have also asked you to calculate margin percentage. That you can easily calculate. Understood? This is the one way. But from my point of view, you can use a simple way. This is the ICS solution, but I will give you a simple way from examination point of view. From my way, what you should do? This is a simple way. You will use this now. Any question you can do without any mistake. This format in exam. I will suggest you one tarika, means ICS solution I have already explained. If you want to do as per ICS solution, do it, but every question can't be done with in ICS solution. So I will just first write down fixed consideration. That is what, 10 lakh, 10 lakh, 10 lakh, 10 lakh, 10 lakh. Then write down variable consideration, 1 lakh, 1 lakh, 1 lakh, then 2.5 lakh, 2.5 lakh. Total become 11 lakh, 11 lakh, 11 lakh, 12.5 lakh, 12.5 lakh. This become total consideration. Then add on actual cost incurred. First year it is 50,000. Correct. Second year how much it is? Second year 1,75,000. Third year how much? It is 4 lakh. Then 2,75,000 and 50. 2,75,000 and 50. This is given. This is the actual cost. Then divide by total estimated cost. Then you write down cumulative actual cost. Always calculate cumulative actual cost. So this is 50,000. Then 1,75,000 plus 50,000. How much? 2,25,000. Then plus 4 lakh. That is 6,25,000. Then plus 2,75,000. That is 9 lakh. And then become 9,50,000. Then around total estimated cost. This will be 9,50,000. 9,50,000. 9,50,000. 9,50,000. 9,50,000. Correct? Understood. Now calculate revenue to be recognized. Revenue to be recognized. So this will be 11 lakh. First year 11 lakh. 11 lakh. Multiply with this. Multiplied with this means suppose this is A, this is B. So do A divided by B. A divided by B. So into what? 50,000 divided by 9,50,000. How much it is coming? First year it will come 57,895. 895. Then second year 11 lakh into 2,25,000 divided by 9,50,000. How much it is coming? 2,60,000. 526. 526. Then once again 11 lakh into 6,25,000 divided by 9,50,000. This will be 7,23,684. 684. Then 12,50,000 into 9 lakh divided by 9,50,000. It is 12,50,000 divided by 9,50,000. 9 lakh. How much it is coming? 7,84,000. 7,84,210. 210. The last one it will be what? It will be 9,50,000. It will be 12,50,000. So can you see we have recognized revenue on cumulative basis. So this is cumulative revenue. Now write down revenue of each year. 57,895. Then this minus this, this minus this, this minus this, this minus this, you can find out. Then minus actual cost. Your same answer will come without that working note. Means there is no need to do any cumulative catch-up basis working note. Directly your same answer will come. So this is more easy to understand, and in this you will never do mistake. Why? Because in this question, even though their estimated cost also changes. Suppose in the exam they have given that first year this was the estimated cost, second the estimated cost changes, then also your answer will be correct. This is more perfect answer from examination point of view. So I will say follow this way. Otherwise, if you have understood ICS solution for this particular question, you can follow this. Understood? Have you understood this point? Any doubt? Any doubt? Follow. So this minus this is coming how much? 7,84,010 minus 723,684 coming 4,06,526. Just see what is their answer. 4 lakh. So देखो 4 lakh 6. There is some difference coming because of approximation. There is some difference coming because of approximation. But we are getting some accurate answer. We are getting some accurate answer. What is point? चलेगा? Okay. Have you understood? Any doubt? No doubt. Now, so this also you have understood how to do reassessment of variable consideration. Yes, sir. Then there is one concept of significant financing component. Significant financing component, of course, what India's 115 says that if the financing component is significant, then we to also give the effect of time value of money. It means can is a transaction price, suppose that is payable after some year, we need to find out present value of transaction, present value of that consideration, that will become the transaction price. Suppose the amount is payable after 2 years, the present value of this will become transaction price. The present value of this will become transaction price. Sometimes we receive in advance. So if you have received in advance also, then also we need to give the effect of time value of money, and after adding interest, whatever amount is coming, that will be the transaction price. So it can be two way around. It can be two way around. But what is the point that we need to understand? How to find out the the discount rate. How to find out the discount rate? What India's 115 says that discount rate will be determined in the following ways. First is the contractual rate of interest explicitly mentioned in the contract. If yes, and that is at market terms, means that represent the significant financing transaction with the customer. Means if you have done the separate transaction, separate financial transaction with the customer, that rate of interest would have been given. Correct now. Then it means it is at market terms. If it is a market terms, then discount rate will be equal to contractual rate of interest. But if it is not at market terms, then we should determine the discount rate, and if the contractual rate of interest is not mentioned in the contract, then also we should determine the discount rate. So how to determine the discount rate? They have given two preferences. First, use incremental borrowing rate. Incremental borrowing rate of the supplier. So we need to use the incremental borrowing rate of seller. If that cannot be determined, then we can use the interest rate implicit in the transaction. Interest rate implicit in transaction is nothing but IRR. The first preference should be given to what? Incremental borrowing rate. If that is not given the question, then use interest rate implicit in the transaction. Understood? Have you understood this point? I hope you have understood. Correct. Now there is one question based on this which can be asked in exam. This question. Is given. ST Limited enter into a contract with the customer to sell an asset. Control of the asset will be transferred to customer in 2 years. 2 year means, of course, it is a significant financing component, or it represents significant financing component. The performance obligation will be satisfied at a point in time. The contract includes two alternative payment options. Payment of rupees 5,000 in 2 years when the customer obtain the control of the asset, or the payment of 4,000 when the contract is signed. Either pay right now 4,000 or pay after 2 years, that is 5,000. The customer elect to pay 4,000 when the contract is signed. ST Limited conclude that contract contain a significant financing component because the length of the time between when the customer pay for the asset, when the entity transfer the asset to customer, will as well as the prevailing interest rate in the market. This is all a bakwas. The interest rate implicit in transaction 11.8. Now they have given interest rate implicit in a transaction 11.8%. Is can I say if you find out a present value of 5,000 in 2 years, that will be equal to 4,000. This will equate this, which is the interest rate necessary to make the two alternative payment option economically equivalent. However, the entities determine the rate should be used by adjusting the promised consideration is 6%, which is the entity incremental borrowing rate. Now you say you'll use 11.8% or 6% for finding out the transaction price. Bolo. Will use 11.8%, 6%. So first preference will be given to 6%. So you have received some advance. First journal entry, cash account debit to contract liability 4,000. Now you will add interest by using 6%. By using 6%, so interest expense account debit to contract liability for 2 years they have done directly. So you can see 4,000 into 6%. First year 240, correct. Then second year it will be 254. So total become 494. So they have done one compound journal entry for 2 year interest expense account debit to contract liability. Now it become 4,494. That will be the amount of revenue. That will be the amount of revenue. Contract revenue, liability account revenue, that is 4494 will be the answer. Understood? At this point, yes sir. This is one good question which can be asked in exam. Then this also done. This you read. This is also important. What is this? Is sometime what happen? Even though there is a significant financing component, then also the will not calculate transaction price by discounting way. Means there is some overriding provision for significant financing component. This is also important. Just read it. Just read it by your own. Correct? Understood? Have you understood this much? Follow. This much you understood? So sometime what happened? Overriding provision of significant financing component means a contract with the customer would not have a significant financing component if any one of the following factor exists. If the customer has paid in advance and the delivery has delayed the request of customer, then it will not be considered as having significant financing component. Second, a substantial amount of consideration is variable. The substantial amount of consideration is variable, then it will be of course dependent on some future outcome. So of course the payment will be done only when that outcome is satisfied. Then also it will not be considered as having significant financing component. Or the difference between the promised consideration or cash selling price arises due to reason other than the provision of finance, then also it will not be considered to have a significant financing component. For example, we also receive some amount in advance, correct now, but this is only for what? Only to make sure that there is no chances of bad debt. So sometimes we receive advance, so in only to protect our interest for getting the entire amount. In that case, it is always assumed that there is no significant financing component. There is one practical expedient that whenever the length of the period between the payment date and the transfer date is 1 year or less than 1 year, then also will not use the significant financing component. Means there is no need to discount the amount. Got this point? Correct? This is also important. There is one practical expedient, means an optional exemption has been given. An optional exemption has been given. Then the next point is non-cash consideration. Non-cash consideration, what they want to give, sometimes we receive consideration in non-cash. In that case, the non-cash consideration will be measured as per what value. So whenever we receive some non-cash consideration, then it will measure at a fair value of non-cash consideration received, and if that cannot be measured reliably, then as per the standalone selling price of goods and services given up. The first preference will be given to what? The fair value of non-cash consideration received. If that cannot be measured reliably, then second preference will be given to the standalone selling price of goods and services provided. Standalone selling price of goods and services provided. So it shall be measured by reference to the first preference will be what? At fair value of the non-cash consideration. If the fair value of non-cash consideration cannot be measured reliably, then second preference will be given to the standalone selling price of the goods and services promised. Correct? At this point is one question, good question of this. This question: A Limited, a telecommunication company, enter into an agreement with B Limited, which is engaged in the generation and supply of power. The agreement provided that A Limited will provide 1 lakh minute of talk time to the employee of B Limited. A Limited will provide 1 lakh minute of talk time to the employee of B Limited in exchange for getting power equivalent to 20,000 units. A Limited normally charges 0.50 per minute and B Limited charges 2.5 per unit. How should revenue be measured in this case? So can I say both are receiving some non-cash consideration for A Limited? But what they are receiving? A Limited is a tele, so they are providing talk time and they are receiving what? Power supply. So the transaction price of talk time will be equal to the fair value of non-cash consideration received. So how much they are getting? They are getting power equivalent to 20,000 units. So 20,000 units multiplied by their Fair value is what? 2.5 per unit into 2.5, 20,000. 20,000 into 2.5 is they will recognize the revenue of 50,000. Now from B's point of view, what they are receiving? They are receiving talk time. How much talk time? 1 lakh, and 1 lakh into what? 0.5. So it is also coming 50,000. It is also coming 50,000. So just say on the basis of above, revenue recognized by A Limited will be the consideration in the form of power unit that is expect to be entitled for talk time sold. That is rupees 50,000. The revenue recognized by B Limited will be the consideration in the form of talk time that it expect to be entitled for the power unit sold, that is also equal to 50,000. Understood? Got this point? Yes, sir. Then next point is what? Consideration payable to a customer. Consideration payable to customer. Sometime what happen, by way of gift, voucher or anything, sometimes some consideration is payable to customer. Correct? Now if the consideration is payable to the customer, what Ind AS 115 says that whatever consideration is payable to customer, that will be reduced from transaction price, unless whatever you are paying that does not represent a separate purchase from the customer. Is if you are purchasing from the customer and because of that reason you are paying some consideration to customer, then that will be accounted as separate purchase as per respective Ind AS. As per respective Ind AS. What Ind AS 115 says that is the consideration payable to customer, is the consideration payable to customer a payment for distinct goods or services from the customer? No. Then account for the consideration as a reduction of transaction price. If yes, then can I say account for the purchase of goods or services in the same way as the entity account for the other purchase from any other supplier, means as per respective Ind AS. But sometimes the consideration whatever you are paying that exceed the fair value of the goods and services purchased from the customer. Suppose you are paying 1 lakh, but the fair value of goods and services purchased 90,000. 90,000 will be accounted as purchase, but 10,000 will reduce from the transaction price. 10,000 will reduce from the transaction price. Understood? Got this point? I think in this, so I have one question. I have one question. This is the only question. An entity that manufacture consumer goods enter into 1-year contract to sell goods to a customer that is a large global chain of retail store. The customer commit to buy at least 15 crore product during the year. The contract also require the entity to make a non-refundable payment of rupees 0.5 crore to the customer at the inception of the contract. Means the supplier will pay customer 1.5 crore. Correct? Understood? The 1.5 crore payment will compensate the customer for the changes it need to make to his selling to accommodate the entity's product. Means they have done some changes in the furniture, etc. to store the goods given by the supplier. The entity does not obtain the control of any right to the customer sale. Means entity does not have any control in that furniture and fixture whatever they have created, thus determine the transaction price. So of course it is understood that this is the consideration payable the customer, and the seller is not purchasing any separate goods and services from the customer. Understood? Yes, sir. So therefore that will be reduced from the transaction price. So you can see they have committed for 15 crore, divide by 12. Please can I say every year, every month it will be how much? Every year, every month, 15 divided by 12. Every month they will purchase 1.25, and 1.5 crore represent 10% of 15 crore. So can you say every month we should reduce 1.10%? Every month we should reduce 10%. We can say 1.25 minus 10%. This we recognize revenue equal to how much? Correct? 1.25, or we can say in this way 0.5 divided by 12. So we'll minus every year how much? 0.125. It is coming how much? 1.25 minus 0.125. That is coming how much? We recognize revenue equal to 1.125. This much revenue will be recognized every month. This much revenue will be recognized every month. Correct? Got this point? Have you understood this? Got this point? Yes, 100% correct. Whatever Aravindam you are saying, that is 100% correct. But this point, the same calculation has been done. Just do it. Then step number 4 is what? Allocating the transaction price to performance obligation. So what Ind AS 115 says that we should allocate a transaction price in the ratio of standalone selling price of the goods and services. You need to find out a standalone selling price. Normally standalone selling price will be given in the question, but sometimes we are not able to directly observe the standalone selling price. In that case, what Ind AS 115 says that we need to estimate the standalone selling price. There are three ways of estimating standalone selling price. First, adjusted market assessment approach is go to the market, just find out what your competitor is charging. That will become the standalone selling price of the goods and services whatever you are providing. That cannot be identified. Then we can use the expected cost plus profit margin approach. Is estimate a cost of providing that goods and services at some reasonable profit margin. That will become the standalone selling price of that goods and services. That is also cannot be applied. Then last is what? Residual approach. Just find out the total standalone selling price of the goods for which we can calculate, then minus that total standalone selling price with the total price. The residual amount will become the standalone selling price of other goods and services. For example, ABC, the total transaction price is 1 lakh right now. For this we have estimated 20,000. For this we have estimated 50,000 standalone selling price, but this cannot be identified by one method or second method. Then for this we'll apply residual approach. So for this residual approach will be what? 1 lakh minus what? 70,000. Automatically the residual approach is what? 30,000. 30,000 will become the standalone selling price of C. Standalone selling price of C. This you have understood. Also you have understood. Now there are two important concepts: allocation of discount and allocation of variable consideration. Now what Ind AS 115 says that discount will be allocated to each performance obligation in the ratio of standalone selling price only, but sometimes discount related to one or more but not all performance obligation. Then in that case discount will be allocated to one or more but not all performance obligations. Same to same, but they are saying variable consideration is normally allocated to all performance obligation in the ratio of standalone selling price. Sometime variable consideration may relate to one or more but not all performance obligation. In that case variable consideration will be allocated to one or more but not all performance obligation. Understood this point? So this can be done, means variable consideration can be allocated to one or more but not all performance obligation when two conditions are satisfied: when the terms of variable payment relate specifically to one or more performance obligation, and second, when the allocation of variable consideration to one or more performance obligation but not all performance obligation is consistent with the allocation objective. If these two conditions are satisfied, then we can allocate variable consideration to one or more but not all performance obligation. Understood? Correct? Have you understood this point? Yes sir. Correct. Then the last step is satisfying the performance obligation. So what do you mean by satisfying the performance obligation? Means when the performance obligation is satisfied, then we need to recognize the revenue. Now what Ind AS 115 say that performance obligations can be satisfied either at a point in time or over the period of time. Now how to identify that it has been satisfied over the period of time or at a point in time? So what Ind AS 115 says that they have given three criteria: criteria A, criteria B and criteria C. Well, any one criteria satisfied, then it is over the period of time, otherwise it will be at a point in time. So let us understand criteria A, B and C. So we'll understand when to recognize revenue over the period of time. Correct? So first they say customer simultaneously receive and consume the benefit provided by the entity performance as and when entity perform. So customer simultaneously receive and consume the benefit provided by entity's performance as and when entities perform. Simply when I say, suppose you are providing accounting services, so first month accounting services has been given, so your client has received the services and consumed the services also simultaneously. Therefore this will be over the period of time. The best way to identify whether the criteria A is satisfied or not, you need to always reassess whatever the work has been completed, whether that work need to be performed by the other seller If the contract has been terminated today, if they need to perform that job again, then it means it is not over the period of time. But if suppose they are not supposed to perform that work again, it means it is over the period of time, because that benefit is already enjoyed by the customer. What they want to say, this criteria can also be applied if the entity determine that another entity would not need to simultaneously re-perform the work that the entity has completed till date, if that other entity were to fulfill the remaining performance obligation to the customer. It means if they are not supposed to re-perform the work, it means whatever the customer received, they have also benefited with that services. So first condition is satisfied, it means it is over the period of time. Second criteria is what? The entity's performance create or enhance the asset, that the customer control the asset when it is created or announced. It is as simple as whenever you are constructing any building in the land of the customer, means the land is controlled by the customer. In that building you are constructing, it means whatever you are constructing, whatever you are creating, whatever you are enhancing, that is under the control of the customer. As and when it is created or announced, it means the control has been transferred immediately only. So this, it means the control will be transferred over the period of time. Over the period means as and when you are constructing, the control has been transferred. The control is transferred over the period of time. Criteria C is also important. What they are saying, entity performed does not create any asset with an alternative use. The entity with an alternative use to the entity, and the entity has an enforceable right to payment for performance completion till date. For performance completed till date. What they are saying, there are 2 points in this. Whatever performance has been given, entity performance does not create any asset with an alternative use to the entity. Means whatever I am providing to you, whatever goods and services I am providing to you, that cannot be used by me for any other purpose. For example, right now I am teaching you, so can you say whatever services I am providing, I can't use it for any other purpose. Correct now? Understood? Second, whatever performance I have completed, I have an enforceable right to demand payment for that. So if these two conditions satisfied, it means control be transferred over the period of time. Control be transferred over the period of time. In this, what is the meaning of right to payment? Right to payment means what? The payment should compensate cost plus some reasonable profit margin. Is if you have right to demand cost incurred till date plus a reasonable profit margin, it means second condition is satisfied. But suppose you can demand only cost without any profit margin, so it means second condition is not satisfied, then it will not be over the period of time. Understood? Yes sir. If any one of the criteria satisfied, it will be over the period of time. Otherwise it will be what? At a point in time. This much have you understood? This much have you understood? Correct. Got this point? Now whenever there is a over the period of time, so of course can I say we need to measure the progress to find out how much revenue should be recognized. So measurement of that progress depend upon two methods. So method of measuring progress of a performance obligation, ki how much progress has been done. Based on that progress, we recognize the revenue. Correct now? So there are two methods, output method and input method. From exam point of view, input method is only important, but output method means what? We'll find out the value of goods and services provided till now. That much value will be recognized as revenue. Means that will be given the question key, this much value of goods and services has been provided, so that much value we recognize revenue. So in exam normally they ask input method, and under input method they will ask you cost to cost method. This will measure the progress based on cost to cost method. Means what we'll do, I mean right now when question we have done now, we'll find out the actual cost incurred divided by total estimated cost. Total estimate cost, this much progress has been completed in percentage form. This is known as cost to cost method. This is known as cost to cost input method. Got this point? So normally from exam point of view, cost to cost method is only important. Got this point? But in cost to cost method, whenever you are applying input method, following adjustment may be required when cost based input method used. There are two special points. First special point is what? Whatever abnormal loss has been incurred, whatever cost incurred does not, means whenever cost incurred does not constitute an entity's progress in satisfying the performance obligation means simply is in simple, but if any abnormal loss has been incurred, that abnormal loss should not be considered to find out the progress of performance obligation. Means whatever abnormal loss has been incurred, that should be excluded from this actual cost and total estimated cost. So that will of course will eliminate that. Correct. Second point, which is more important, from this examination में question भी आया, when the cost incurred is not proportionate to the entity's progress in satisfying the performance obligation. Means whatever cost you have incurred, that is not proportionate in entity's progress in satisfying the performance obligation. In that case, what Ind AS 115 says that revenue should be recognized only to the extent of cost incurred. Revenue should be recognized. Revenue should be recognized only to the extent of cost incurred. We'll take one question based on this, but this can be applied only when 4 conditions are satisfied. Only when 4 conditions are satisfied. First condition, goods do not represent as a separate performance obligation. Is whatever goods you have purchased or whatever supplied, that does not represent a separate performance obligation. Second, customer is expected to obtain the control of goods significantly before receiving the services. Means you have got the control of that goods significantly before the services is actually received. Cost of such goods is significant in relation to total expected cost, so that is a significant cost. Fourth point, entity purchased the goods from a third party. Means seller entity has purchased the goods from a third party and does not involve in the manufacturing or designing of such goods. They are not doing any alteration on such goods. That goods was transferred to customer as it is. So entity purchased the goods from third party and does not significantly involve in designing and manufacturing of goods. If these 4 conditions satisfied, then we recognize revenue to the extent of cost incurred only. To the extent of cost incurred. This is good question. One question will take. Already asked in exam. This point has been asked in exam. Let me take that question. Question of air condition. Company X enter into an agreement on Jan 1, 2001 with a customer for renovation of hospital and install a new air conditioner for total consideration of 50 lakh. Installation, renovation and installation. So can I say this year air conditioner will be actually integrated with the renovation. Therefore, can I say yes, here in significant integration services provided. Therefore, it will be one performance obligation only. The promised renovation services, including the installation of new air conditioner, is a single performance obligation. It is mentioned also. Satisfied over time. It will be over time also. Total expected cost is 40 lakh, including 10 lakh for the air condition. Means out of 40 lakh, air condition 10 lakh and the balance for the renovation. The company X determined that it act as a principal in accordance with IND AS 115 because it obtained control of the air conditioner before they are transferred to the customer. So can you say in this case they are acting like a principal, so they will purchase the air conditioner from third party and will supply to the customer without any modification, without any designing or manufacturing. Yes sir. The customer obtain control of air conditioner when they are delivered to the hospital premises. Once it is delivered, customer obtain the control also. So they obtain the control significantly before the renovation of the building. Company X uses an input method based on cost incurred to measure its progress toward the complete satisfaction of performance obligation. As on 31st March 2001, other costs excluding the air conditioner were 6 lakh. So other means out of this 30 lakh, 6 lakh has been incurred, and out of this 10 lakh is already incurred. The company X should include the cost of air conditioner in measure of progress of performance obligation. How should revenue be recognized for the year ended? So they should not include cost of air conditioner in measure of the progress of performance obligation. Why? Because all these conditions are satisfied. We should write down these all conditions that goods do not represent the air conditioner do not represent a separate performance obligation. Customer has obtained the control of goods significantly before renovation of building. correct? Cost of such goods is significant in relation to total cost. An entity purchase means seller entity purchase the goods from third party which is supplied to the customer without designing and manufacturing of such goods. Because all the conditions are satisfied, therefore that cost of air conditioner will not be included in the total cost for measuring the progress of performance obligation. Got this point? So in this case, but the out of 60, 30 means how much percentage of work has been performed. 60 divided by 30 means 20% work has been performed. What they are saying, just try to understand. Your revenue will be what? Your revenue for for uh, for renovation of building, it will be 20% of transaction price. 20% of transaction price. What was the total transaction price? 50 lakh. Out of 50 lakh, out of 50 lakh, 10 lakh will be for air conditioner and 40 lakh will be for building renovation. Correct now. 40 into 20% will be how much? We recognize revenue how much? 8 lakh. And for air conditioner, recognize revenue to the extent of cost incurred. The extent of cost incurred. The cost incurred 10 lakh to recognize 10 only. So 18 lakh will be the cost. 18 lakh will be revenue. The cost will be how much? For renovation of building 6 lakh, and for air conditioner 10 lakh. So this becomes 16 lakh. The total profit will be how much? 2 lakh. Profit will be how much? 2 lakh. That only they have done. Check karo. 18 lakh, 16 lakh, 2 lakh. Understood? Have you understood this particular point? This is most expected question. Already I think 2 times they have asked in exam. 2 times they have asked in exam. Got this point? Yes sir. आगे चलें, आगे चलते. This is all you read. Okay, this is all you read. Transfer of control at a point in time. So that will be normally given in the question. What is the point in time when the control is transferred? That will be always given in the question. Now, coming to guidance on a special aspect. Guidance on a special aspect. First is what? Customer option for additional goods or services. Customer. Sometimes what happens, we provide some option to purchase additional goods and services. Sometimes we provide option to purchase additional goods and services. What Ind AS 115 says that whatever option you are provided, that is a separate performance obligation. That is a separate performance obligation. So whatever consideration you have received, that should be allocated to the the both performance obligation. Means, can I say, one you have done sale of goods, with sale of goods you have given one option to purchase additional goods and services. There are two performance obligations. Whatever consideration you have received, what is the transaction price, that will be allocated to both performance obligation in the ratio of their standalone selling prices. And then you only recognize revenue for the goods which has been transferred. Whatever allocated transaction price for the option, that will be considered deferred revenue, and that will be recognized as a revenue only when that option has been redeemed. Correct? Or option excess, or option when the option is expired, whichever is earlier. Understood? So that is only given. So for consideration received or receivable on initial sale, will pass journal entry bank account debit to sale and to liability under customer royalty program. This is known as customer royalty program. There is some point system which is given to you on each purchase that you can redeem at the time of additional purchase. Correct? Now this is also known as deferred revenue. Deferred revenue. Now this deferred revenue will be recognized when the award credit is redeemed or when it is expired, whichever is earlier. So whenever it is redeemed or expired, we'll pass one journal entry deferred revenue account debit to revenue. Understood? I think this is also asked in exam many times. You have also done this type of question. You want me to take one question based on this? Yes, sir. Please take one question. Okay, sir. I think I don't have any question in expected question. I need to go to what? India's one. question have been asked, I think 2 times in exam. An entity enter into contract for sale of product A for rupees 1000. As a part of the contract, entity gives the customer a 40% discount voucher for any further purchase up to rupees 1000 in the next 30 days. So some discount voucher has been given which can be redeemed. The entity intend to offer 10% discount on all sales during the next 30 days as part of seasonal promotion. Out of 40% discount, 10% is available to all customers. This 30% is material discount, so 30% will be considered. A 10% discount cannot be used in addition to 40% discount, so 40% and 10% is included, correct? The entity believe that 80% likelihood that a customer will redeem the voucher, and on an average the customer will purchase 500 additional product. You need to find out standalone selling price by taking this point into consideration. Batao, 80%. 80% is the probability that customer will redeem the voucher. So what is the 500 is the amount, 80% is the chances, and the discount is what? 30%. What is the value of that voucher? 500 into 30% into 80%. 120 become the standalone selling price of that voucher. 120 become the standalone selling price of the voucher. Now there are two things. One is the sale of product A. One is the discount voucher. What is the standalone selling price? For this standalone selling price 1000. For this standalone selling price 120. Total become 1120. Understood? And what is the total transaction price? 1000. This 1000 will be allocated in this ratio. 1000 divided by 1120 into 1000. So it will be allocated how much? 892. 892 will be allocated in this minus 1000, and 108 will be allocated in this. They have done approximation. I think 890 and 110 they have done. They have done some approximation. The solution is same only. So they have done some approximation figure. I hope you have understood this. Got this point? Follow. 1000 divided by 892. Of course, you can do also 892 in exam. It means can I say they will recognize revenue only to the extent of 890, and 110 will be what? Deferred revenue that can be recognized as revenue only when that voucher is redeemed or expired, whichever is earlier. It is redeemed or expired, whichever is earlier. Got this point? There is also one good question, 62. This by Ron. This is also good question. Is expected in exam. 62 now is expected in exam. Okay, you have done this question. Question I am saying, this also you do. Must do question. थोड़ा सा different type of question it is. Can you do this question by your own? I think we have done in class also this type of questions. Correct. This you do by your own. कर लोगे? Yes sir. Yes sir. Then coming to next point. We have understood options. Options we have understood. Option we understood. Then second is sale with a right of return. This has, from this also question may be asked, whenever there is a sale with a right of return, but in days 1 and 5 said we can recognize revenue only to the extent of goods which are not expected to be returned. Which are not expected to be returned means any goods which are expected to be returned, for that will create a refund liability. For that will create a refund liability. For example, the total, suppose total goods sold, let's say total goods sold is 50,000. Can you say you have sold suppose 10,000 at a rupees of 10? So it means 1 lakh is the amount received. Out of this, you need to recognize revenue only for the goods which are not expected to be returned. 9,000, suppose you are expecting that it will not be returned as per your experience, whatever. 9,000 into 10 means you recognize only what? 90,000. And for the balance you recognize the refund liability. A refund liability. Refund liability will be how much? 10,000. Now whatever refund liability you have created, it means can I say some extent you have not transferred the control of goods to the customer. That goods is lying in the premises of customer, but that in that you have the control, so that become your asset. You need to pass one more journal entry. The journal entry will what? You need to recognize inventory, and you should adjust this amount to the cost of sales. You'll pass one journal entry, inventory account debit to cost of sales, for how much goods? 1000, which you are expected to be returned into. Can you see the carrying amount with the carrying amount of the inventory? With the carrying amount of the inventory. Carrying amount means cost price or NRB, whichever lower. Correct now. That carrying amount minus less less any cost, less any cost of recovery, then less any cost of recovery also. Suppose at a time of recovery you are going to incur some expenses, that will be also reduced to, and at that amount this inventory will be recognized. Understood these 2 points? Correct. That is only given. Check karenge. They have given the revenue for the transfer product to which the entity expect not to be returned, a refund liability for the product expected return, and an asset with a corresponding adjustment to cost of sale for its right to recover product from the customer on settling the refund liability. An asset, what they have written, an asset recognized for the right to recover product from a customer on settling a refund liability shall be initially measured by reference to the carrying amount of the product, for example inventory, less any expected cost to recover those product. What is point? Understood? There is one question of this nature given ICS study matter that you do. Like I expected, this can be also expected in exam. Non-refundable upfront fee, from my point of view, is not expected. Just do it. Is sometime what happens, some non-refundable upfront fee is paid. So suppose you have paid some upfront fee which is non-refundable. So how to recognize this as a revenue? That is given. That you read by own. Consignment arrangement. This is very important. Already question have been asked. So and what they are saying, any arrangement which is a consignment arrangement, in that case revenue will be recognized by the consignor on gross basis and by consignee on net basis. Net basis means only commission income. Correct now? So if there is a consignment arrangement, so be careful about the recognition of revenue in the books of consignee. In the books of consignee will recognize only the net commission as what revenue. What they are saying, an arrangement is a consignment arrangement if the following indicator exists. The product is controlled by the entity until a specified event occurred, means until the sale has been done by consignee. The entity is able to require the return of the product or transfer the product to third party, means the consignor can require to return that product or can be transferred to any third party. The dealer does not. Dealer means consignee. Consignee does not have an unconditional obligation to pay for the product until it is sold. In the consignment arrangement, revenue is not recognized when the product are delivered to the consignee, because control is not transferred. Revenue is generally recognized on sale of the goods to the customer and customer. But it's fine. Then there is a concept of principal and agent consideration. This is also very important. This question have been asked 2 times in exam. I think 3 times in exam. 3 times. So then we need to identify principal or agent. So how to identify principal agent? That depends upon 4 conditions. Following are the indicator that entity is a principal. These are the indicator that the entity is a principal. Now whenever entity is a principal, we recognize revenue on gross basis, and if the entity is what? Agent, then we recognize revenue on net basis. Net basis means only commission income. Only commission income. What are the indicator? The entity is responsible for fulfilling the contract. Correct? The entity have an inventory risk. The entity have a discretion in establishing the prices. The entity is exposed to the credit risk for the amount receivable from the customer. These are the indicator. If this indicator exists, it means the entity is what? Entity is responsible for the entity is what? Principal. Entity is principal. So these are the indicator which indicate which indicator. Correct now? So it means the entity is responsible for fulfilling the contract. Entity have the inventory risk. Entity have discretion in establishing the prices. The entity is exposed to the credit risk. Means if any one of the indicator exists, it means it is what? The entity become a principal. Any one of the indicator exists, it means the entity become what? Principal. Understood? There are 2 questions. Both questions have been asked in exam. So just do it by your own. I think has not been given in expected question, but this is a question of sale with a right to return. Means topic wise question given. Non-refundable fee, one question has been given. Consignment agreement, one question has been given. This is principal agent consideration. If you read this question number 67, in both now the answer is principal only. The D limited is a principal. Here also you can see there is a principal, but you need to explain why it is a principal. Just read it. Know the content, you can write down. If you know the content, you can write down. Chalega? Yes, sir. Then next point is what? Sale based or usage based royalty income on license of intellectual property. Sometimes whatever you receive royalty income on sale based or usage basis. Suppose you have given some intellectual property. On the intellectual property, you are receiving some royalty income. Royalty income is based on sales or usage. But in AS 115 says that in this case, revenue recognized at a date which is later off when performance obligation is satisfied or when the sale or usage occur, whichever is later. Means revenue will be recognized when subsequent sale or usage occur or when performance obligation is satisfied, whichever is later. Just to means just try to understand. Suppose you transfer some intellectual license. Suppose you transferred a license at this point of time on 1/4, but sale occurred at this point of time, and you have transferred license, means performance obligation was satisfied at this point of time, and you have received 1 lakh. So even though the performance obligation is satisfied, but you cannot recognize this 1 lakh as revenue because till now sale has not occurred. You can recognize this 1 lakh only when what? Sale has occurred. When the sale has occurred, means this, when it is, sorry, not 1 lakh, means suppose the fees is 2% of sales. Even though performance obligation is satisfied, whatever 2% of sales you can recognize only on what? When the sale has occurred. Only when the sale has occurred. Got this point? Whichever is later. Got this point? Yes, sir. Then bill and hold arrangement. Sometime whatever invoice is made, but still the possession has not been transferred. In that case also control may be transferred if some condition is satisfied. Means bill has been made, but the possession has not been transferred. Means if you are holding the goods on behalf of the customer, now the question is that should we recognize revenue? But in AS 115 says the control is transferred, recognize revenue, but how to find out whether the control has been transferred or not? In that case, they have given 4 conditions. All these 4 conditions satisfied, it means revenue should be recognized. First is the reason for the bill and hold arrangement is substantive. Means, can you say substantive means this possession has not been transferred due to the request of the customer. If the customer is requesting, then we say it is substantive. Correct now. So the reason for the bill and hold arrangement is substantive. First condition. Second, has the product been identified separately as belonging to the customer? The product has been identified. Has the product ready for physical transfer to customer? Means whether it is on the manufacturing stage, then it cannot be considered as transfer. So if it is ready for delivery, then we say yes, the control can be transferred. Does the entity have the ability to use the product or direct it to some other customer? It means the control has not been transferred. To no, the entity does not have the ability to use the product or to direct it to the another customer. It means then customer has obtained the control and the entity recognized the revenue on a bill and hold basis. There is one question, this question has been also asked in exam. One time there is one question of this nature that you do. Already I have in expected question also. I have also given in the expected question this time. This question 13, just read it, you will be able to understand. Question 13, you can read it. Correct? Chalega? Yes, sir. Then warranty. The warranty, what in AS 115 say, warranty are of 2 types: assurance type warranty and service type warranty. Correct? Assurance type of warranty is always given. Service type of warranty is an additional warranty apart from assurance type of warranty. But they say, if the customer has an option to purchase the warranty separately, if yes, the customer has an option to purchase the warranty separately and says yes, then the promised warranty will be accounted as a separate performance obligation, correct now, and then revenue recognized by applying all the steps. So it will be a separate performance obligation, then the transaction price will be allocated to such performance obligation as per step number 4 and recognize revenue. But if it is not available separately, then we need to ask one question: is the promise warranty provide a customer with a service in addition to assurance? Is whether we are also providing a service warranty in addition to assurance warranty? If the answer is no, then there is no need to then uh, warranty is not a separate performance obligation. Then we need to account it as per Ind AS 37. Is whenever there is a assurance type of warranty, then whatever expected cost which we may meet for warranty services will be accounted as per Ind AS 37. But if yes, is with assurance we are also providing service type of warranty, then it will be a separate performance obligation. Then entire transaction price will be allocated on the basis of step number 4 and then recognize revenue accordingly. Understood this point? Correct. We have one question based on this. This is also expected in exam. An entity manufacture and sales computer that indicate an assurance type of warranty for first 90 days. The entity offers an optional extended coverage plan under which it will repair or replace any defective part for 3 years from the expiration of assurance type of warranty. Means they have also given some extended warranty, which is nothing but service type of warranty. Since the optional extended coverage plan is sold separately, so it can be sold separately. The entity determined that 3-year extended coverage represents a separate performance obligation. Understood? That is service type of warranty. The total transaction price for the sale of computer and the extended warranty is 36,000. So what is the consideration? 36,000. The entity determined the standalone selling price of the computer is 32,000 and extended warranty is 44,000. So sum total is also coming same only. However, this is the standalone selling prices. This may be either, it can be less than this also. Then we need to allocate this transaction price in this ratio. But even though you allocate, it will come 32 and 4,000 only. The inventory value of computer is 14,400. Furthermore, entity estimated based on its experience, it will incur 2,000 cost to repair defect that arise within 90 days coverage period for assurance type warranty. So for this will apply Ind AS 37. Correct now. There are 3 transactions. First, we need to recognize this revenue. Revenue will what? First entry will what? Bank account or receivable, whatever. Receivable account debit 36,000. Out of this, how much we recognize the revenue? Revenue will be 32,000. Revenue will be 32,000. The first entry will what? Receivable account debit 36,000 to revenue how much? 32,000. And case we will say to deferred revenue. Deferred revenue will be 4,000. So this will be recognized over the period of warranty. Over the period of warranty. This is the first journal entry. Second journal entry, can you see there is a cost of computer given, so that become cost of sales. Account debit to inventory. Debit to inventory. That is 14,400. 14,400. And there is one warranty expense also. Third entry will be warranty expense. Account debit. Provision for warranty. To provision for warranty. This will be as per Ind AS 37. I think they have given 2,000. 2,000 will be, I think they have given 2,000. 2,000 will be the this journal entry. In the solution, they have given one compound journal entry for 1 and 3. They have given one compound journal entry for 1 and 3, but we can separate it. Understood? What the entry they have given. They have compounded this journal entry 36,000, 4,000, 2,000. Then warranty expense, accrued warranty cost they have written. We should write down what? To provision for warranty. That is better. Then 14,400 cost of goods sold to inventory. Got this point? Yes, sir. Yes, sir. Done. This also done. Then coming to the next point, warranty you understood? The licensing. Next point is licensing. Till now, they have not asked any question on licensing, but they have given some questions on licensing. They have given some question on licensing, but they are saying, if suppose licensing means what? A license to establish a customer right to the intellectual property, means you have given some right of intellectual property to the customer. For example, software and technology, motion picture, music and other form of media, franchisee, patent, trademark, copyright. So you have given the license to this intellectual property to other party. So recurring revenue, what they are saying, if the promise to grant a license is not a distinct from other promised goods or services in the contract, means they are not a distinct performance obligation. Correct now. So then an entity shall account both the promise as a single performance obligation, then it will not be considered a separate performance obligation, it will be considered as single performance obligation. Is the best example I will say, suppose you have sold a laptop with an operating system license. Okay, in that case, operating system is the integral part of laptop. Correct now. Therefore, the sale of computer and sale of operating system is not a separate performance obligation, but one performance obligation only, and therefore it will not be recognized as a separate performance obligation. Correct. But sometime if the promise to grant a license is distinct from the other promised goods or service in the contract, then the promise to grant a license will be a separate performance obligation. Then in that case, how to recognize the revenue? What India 15 says that is the intellectual property to which the customer has a right changes during the period of use. Is the license will change throughout the period of license? Is the intellectual property whatever you have provided to customer will change throughout the period? If the answer is yes, then it means the performance obligation satisfied over the period of time. If the answer is no, then it means performance obligation satisfied at a point in time. Then recognize revenue at that point in time when the control is transferred. If yes, now so how will understand it? It is changes. So if it changes, we say it is a right to access. Right to access. If it is not changing, we say it is right to use the intellectual property. There are two terms they have used: right to access the intellectual property, right to use the intellectual property. The intellectual property is not changing, say right to use. The intellectual property is changing throughout the period of use, we say right to access. So how will understand what they want to say? How will understand? In simple word, just try to understand. What they suppose I have given one software to you, and I will always give an updation of that software to you. Is without updation you can't use that software. It means, can I say it will change throughout the period of use? But if I have given one software to record the classes, and you can record the classes without my update, so it means it does not changes even though I am giving some update. So it means you can use and derive the benefit at that particular point of time only. But if you need to wait for the update, it means can the customer receive and the consume the benefit as and when the entity perform, it means it is over the period of time. The customer cannot direct the use of and obtain substantially all the remaining benefit from the license at the point in time when the license is granted. Then in this case, it means it is right to X, it means performance obligation satisfied over the period of time. Understood? So from the question, normally we can understand whether it changes or it not changes. However, they have given three conditions. If these three conditions satisfied, it means it is right to access, means the intellectual property will change. What are the three conditions? Entity is required or reasonably expected undertake the activities that significantly affect the license period. It is required or is reasonably expected to undertake some activities which will change the intellectual property during the license period. Correct now. To undertake activity, the license expose the customer to any effect of entity's activity. that activities of the entity, the license will be exposed. His license will be either it will increase the benefit of license or decrease the benefit of license. The entity's activities are not a separate performance obligation on the contract. I'll just give one example. Right now, IPL match is going on. Suppose there is one team, Chennai Super King, and this Chennai Super King has given me a right to use the logo in my product. So it means what this CSK means, we are doing from CSK point of view. CSK becomes supplier. So they have sold, they have transferred me a right, and I can use the logo of CSK in my product. Understood now? Now just try to understand this contract. CSK need to perform one activity. It means they need to play the IPL match or not. Means entity, the CSK is required or reasonably expected to play the match. Is this become an activity which they should undertake? They are not playing, so then what is the use of this logo? Correct now? And can you see if that in that while playing the match, they may either win or lose? I mean, right now IPL match is going on, CSK is not performing good. So can you say the license exposed to the customer to any effect of that activity is undertaken? Is, can you say the value of the right will increase or decrease to the performance of the performance in the match? And the playing of the match is not a part of a separate performance obligation in the contract. That whatever they are playing the match, that is not a part of a separate performance obligation in the contract. If this all condition is satisfied, it means, can you say the right will changes throughout the period of use? The right will change now because they are playing some game. Because of that reason, the right will change throughout the period of use. And therefore, can you see there is a right to access, not right to use. These conditions are not satisfied, then we'll say right to use, and then we recognize revenue at a particular point of time. I've done. Repurchase agreement. This also, I think, only one small question has been given. Till now, no question has been asked. So, repurchase agreement means what? There is some option, or there is some option. There is a forward contract to repurchase the asset. Repurchase the asset. So, there can be forward contract or call option or put option. There is a forward contract means what? There is a right as well as obligation to purchase. Call option means what? There is a right to purchase. Put option means what? There is an obligation to purchase. There is an obligation to purchase. Whenever there is a right to purchase, it means, can I say, I mean, right now, so we have not transferred the control, therefore revenue should not be recognized. So what Ind AS 115 says that whenever there is a forward or call option, so what will be the accounting treatment? What they are saying, if the repurchase price is less than original selling price. Suppose the selling price is 120 and repurchase price is 100. So how much I receive? 120. How much I need to pay? Suppose I have sold one asset with a repurchase agreement. So I receive 120, but I will pay you 100. And the control of the goods has not been transferred. So whatever extra amount I have received, that is nothing for the use of the asset, because you have used the asset for a particular time period. So whatever extra amount you receive, that will be lease income and accounted under Ind AS 116 as an operating lease. So I'll become lesser, and that 20 rupees will be recognized as a lease income over the period of contract on SLM basis. Correct? So the contract will be accounted as per lease as per Ind AS 116. However, if that option remain unexercised, suppose the call option was there, but I have not exercised it, then the control has been transferred. If the control has been transferred, the revenue will be recognized at repurchase price. Revenue will be recognized because out of 120, 20 become lease income. So 100 will be the revenue, and it will be recognized at 100 rupees. Understood? Second point, if the repurchase price, suppose, is 120 and original selling price 100. Is I receive 100 but I will pay 120. So it is just like a financing arrangement. It means I was in need of money, therefore I receive right now 100 but I will pay 120. So 20 will be interest element. In this case, whatever amount I will receive, that will be financial liability, and the 20 rupees will be accounted as interest expense over the period of contract by applying Ind AS 109 effective rate of interest. But if the call option remain unexercised, then once again revenue recognized at a repurchase price. Revenue will recognize at repurchase price. I hope you have understood this point. Understood? Correct? Understood? Put option, so I I think that they will not ask, but put option is very easy. Put option means I have an obligation to buy. This customer has an right to sell. It depends upon whether this put option is favorable or unfavorable to the customer. So what Ind AS 115 says that if repurchase price is less than original selling price, and if that put option is favorable to the customer, thus the customer has significant economic incentive to exercise the right. If yes, if it is favorable to the customer, then it will be accounted as a lease, and the difference will be accounted as a lease income as per Ind AS 115. However, no, then it will be accounted as sale with a right to return. So it will be recognized sale with a right to return, with a right to return. If the repurchase price is more than or equal to original selling price, and if it is favorable, then it will be accounted as a financing arrangement. If not favorable, then it will be recognized as a revenue with a right to sale, with a right to return. Understood? Yes, sir. Correct. Now, contract cost. Contract cost. Last time they have asked a question on contract cost also. You're not expecting that they will ask this type of question, and they have asked. Is in ICI any type of question is expected. You can't say this is expected, this is not expected. Any question can come. Therefore, if you have overall knowledge, now you can write down something in exam. You can write down something in exam. I hope you are understanding. Have you understood whatever I have said till now? Have you understood? Correct. Now, contract cost are two type: cost to obtain a contract and cost to fulfill the contract. Correct. Now cost to obtain the contract means what? Any cost which will be incurred while obtaining the contract. Now these are of two types. One is known as incremental cost. One is which are not incremental cost. Means any cost which will be incurred even though you are not obtaining the contract, then that is known as what? These are not incremental costs. These are not incremental costs. Are these costs incremental? If yes, then always capitalize it. Is from exam point I am saying, always capitalize it. Means you recognize this as a contract cost asset. Contract cost asset. Recognize as a contract cost asset. That's it. Correct. And if they are not incremental cost, is this will be incurred even though contract is not obtained, then it will be recognized as an expense immediately as and when incurred. As and when incurred. Correct. This is from examination point of view. Correct. Now we are not going in detail. Simple. Are the cost incremental? If yes, capitalize it. No, then charge it to profit and loss account. Now they may give you this point. Example: suppose commission paid only upon successful signing of a contract. So this is increment only because this will be incurred only when the contract is obtained. So yes, it will be capitalized. Traveling expense will be incurred even though contract is not obtained. Expense. Legal fee for drafting terms and arrangement for party to approve and sign. So of course, can I say it will be incurred even though contract is not obtained. Legal fee paid is abhi to we have done only drafting. It may or may not be obtained. Then it will be expense. Salary for salespeople working exclusively on obtaining new client. So salary need to pay even though we do not obtain the contract. Then it is an expense. Bonus based on sales target. So it will be paid only when the contract is obtained. Then it is capitalized. So these are some simple example I have given. However, in exam also similar question was asked. Got this point? Then second is what? Cost to fulfill the contract. Any cost to fulfill the contract will be always capitalized. But if such costs are not recoverable from the customer, then it will be charged to PL as an expense. So any cost to fulfill the contract can be of two types. Correct. Now there may be some costs which are already covered in some other Ind AS. For example, just try to understand. Right now I am providing services. So I am using camera, I am using mic. So this camera, mic, etc. are already covered under respective Ind AS. That is not covered under Ind AS 115. But there are some electricity expenses. There are some rent which I am paying. There are some other expenses, the employee cost, that are not covered under other Ind AS. So that will be covered under Ind AS 115. So if it is recovered from you, they are recoverable from you, chargeable to you, so then it will be capitalized as a contract cost asset. Otherwise, it will be charged to profit and loss account as an expense immediately. Got this point? Correct? Then you read this point. These all points are not important. Chalega, understood? Then coming to last topic of this, service concession arrangement. Service concession arrangement. Already a question of this asked in exam. Only one question is there that only you do from examination point of view. Apart from this, I will say now do all the expected questions by your own. Correct? Now all the expected questions by your own. Now this expected question you need read only. If you read, now you will be able to understand. Is read solution and then exam में लिख लेना जो आता है. Is the content you will write down. If you write down keyword, now you will get marks. What is point? Last point is what service concession arrangement. Now I hope you all know about Appendix D to IND S15. What is this service concession arrangement? It's an arrangement between a private sector entity, which are known as operator, constructing the infrastructure used to provide the public service or upgrading it. They will do construction of some infrastructure or some redevelopment of such infrastructure which will be by the public at large, and operating and maintaining that infrastructure for a specified period of time. So this is known as service concession arrangement. Now what is the accounting principle? First thing, this infrastructure will not be recognized in the books of operator. We are doing in the books of operator, not in the books of grantor. Grantor is what? The government party, correct now. So this infrastructure will not be recognized as PP in the books of operator. Now recognition and measurement of the arrangement considered. So what they are saying, how to recognize revenue. So revenue recognized based on the principle of IND AS1. However, there are two model. One is known as financial asset model. One is known as intangible asset model. Financial asset model means when the operator has a right to receive the consideration from grantor. If they has a right to receive consideration from the grantor, they will recognize financial asset in their books of account. However, if they have a right to receive consideration from the user of infrastructure service as a toll tax, etc., then we recognize one intangible asset in our books. The first financial asset model. Correct now. So I'm just giving you journal entry. Correct. What they want to say? There are two. One is the construction phase. One is operation phase. What they are saying? Whatever amount you are receiving for construction phase, for constructing the infrastructure, that will be recognized as financial asset. Will pass one journal entry financial asset account debit to what? To revenue from construction. So this will be what? This will be present value of all contractual cash inflow discounted by using effective rate of interest, discounted by using the whatever rate of interest given in the question. You can find out this. Correct? Understood. Correct. Then can I say for operation phase, whatever amount is receivable once the operation service is given, that is also financial asset account debit to revenue from operation. On this, can I say interest income will be also recognized. So this is financial asset model. Correct now. Take one question to understand this. I'm taking the question which is already asked in exam. This A Limited is in the business of infrastructure. Just read it. Silwara Jabalpur toll project. The company has commenced the construction of the project in the current year and has incurred total expense aggregating to 50 crore as on 31st December 2001. Under IGAP, the company has recorded such expenses as intangible asset in the books. This is not correct. The brief details of concession agreement are as follow. Total expenses estimated to be incurred is 100 crore. Out of which how much already incurred? 50 crore. Fair value of construction service given 110 crore. The total cash flow guaranteed by the government under the concession agreement is 200 crore. Means we cannot recognize tangible asset, we need to recognize financial asset. Finance revenue over the period of operation is 15 crore. The interest income they have given. Other income related to service provided during the operation phase, that is not given. So just try to understand what is the total amount to be collected. 200. Out of this, how much is for construction? 110. How much is for interest? Interest will be 15 crore. The balance is how much? 75 crore. This is the revenue from operation phase. So they have asked one overall accounting. They have asked for the entire year. So the entry they have given. This is, I say always bakwas question, but to understand this concept, they have created one illustration, but that also they have asked in it. The first financial asset account debit to construction revenue 110. Then what is the cost of construction which will be transferred to PL during that first 2 year? That is cost of construction 100. So cost of construction transferred to PL to bank 100 crore. And what is the interest income? 15. financial asset to interest income 15. Then what is the revenue from operation? We calculate 75. Financial asset to revenue from operation 75, and then the amount will be collected. Bank account debit to financial asset 200. Done. Done. Yes, sir. Now coming to intangible asset model. Intangible asset model, what they say, the operators recognize an intangible asset to the extent that it has a right to receive, right to charge user of the public services. In this case, it is as simple as that you have acquired one intangible asset from the government and you are provided some construction services to the government. It is nothing but acquisition of intangible asset in some for non-monetary consideration. So what Ind AS 105 and 115 says that in this case the cost price of intangible asset will be equal to fair value of asset given up or fair value of construction services. Fair value of asset given up is fair value of construction services provided, or fair value of asset received is fair value of intangible asset received, whichever is clearly evident. So in this case, of course, they will give you fair value of construction services, that will become the cost price of intangible asset. Then the intangible asset will be amortized over the period of operation. Correct? Yes, sir. And then as and when you recover from customer, that will become revenue from operation. One more question is given. Let us read what they have given. Please. The second point was what? Second point. The Kolhapur-Nagpur Expressway, the company has also entered into another concession agreement with the government of Maharashtra in the current year. The construction cost for the said project is 110 crore. Cost is given. The fair value of such construction cost is 200 crore. This will become the cost price of intangible asset. The said concession agreement is a toll-based project, means recover from public only, and the company need to collect the toll from the user of the expressway. Under IGAP, it has been recognized as an intangible asset. Correct now. So they have recognized the expense incurred on the said project intangible. That is not correct. What will be the correct journal entry? Let's see. First, cost of construction to bank account. That cost of construction will be charged to PL. That is given 1. Then we recognize intangible asset account debit to revenue. That will be that is given 200 crore. Correct now. Then this intangible asset will be amortized during the period of operations. So that is amortization expense. Tangible asset 200 crore. Now what is the amount collected from the user? That is not given, but will pass one journal entry bank account debit to revenue as and when the amount is collected from the user. That information is not given, therefore question mark. In exam also you give question mark. Understood? This question will be only repeated if they ask a question from this topic. Otherwise they have no other question. They created new question, then that will be new question for everyone. Don't worry. I think Ind AS 105 is completed from my point of view. I have done the some question also, and we have done the content or entire revision I have done. I hope this will definitely help you. Now balance question, but means my job is not done fully, means I have done my job, but your job has not been done fully, because for this particular do more and more question, because from this chapter any question can come. I will say for this chapter now any question can come, and all the questions are new, all the questions are different in this. Chalega? So can you do by your own? Fast revision करना, read the question and fast आगे चलते जाना. Only see what they have done and just go through. At this point, don't waste much time. I hope you have understood. So I am just giving all the best to you. All the best to you. All the best. Now only one thing I just want to say. From tomorrow I am once again coming for marathon, but don't waste your time. 29, 31. I'll come in Unacademy platform. Unacademy YouTube channel. Unacademy, you know, but in Hindi. So first I will do FS, business combination, and Ind AS 116. Then I will do second, I will do financial instrument and share-based payment and one analysis of financial statement. If you want to do this with me, so I will take almost all the questions there for analysis of financial statement. And this one you can join me. This will do small Ind AS. For example, I will do Ind AS 108, Ind AS 37, small Ind AS. Correct now. So what I will do is initially all those Ind AS which I have not done initially. Then I will do those Indias which I have done. So you can join this first to cover up small Indias if you want to join, but that will be in Hindi. This will be totally in Hindi. Totally will be in Hindi. So I have some contractual commitment to them. I need to take this class in Hindi. Now you can't force me to take in English in that system. I have done my job for all my students who are taking my classes in English. First I have done your job, then I am coming there. Okay, sir? Correct? Okay, so if you want to join, or you can spread this message to others so they can join from tomorrow. 29, 30, 31 will meet in, if you don't, because 29 already we have done, 30 already we have done, only analysis of finance system in that chapter you have not done. Got this point? Correct? I hope this entire classes, whatever we have done, has boosted your confidence, and I am expecting very good marks from you all. Just after exam, message me how was your exam. Correct? Whether this batch has helped you or not, just message me. But don't discuss the paper. Don't discuss the paper. Don't see any review of paper. I will give the review of financial reporting paper. But don't see the review. Don't see anything. Don't discuss the paper with anyone. Go and prepare for AFM. Even though, suppose, just try to understand. In FR, one thing I am saying, all questions are from out of book. Correct? Don't panic in exam. Don't panic in exam. I am saying don't panic in exam. Just have belief in yourself. Whatever you write down. Because if it is out of book now, it is out of book for everyone. You are not exceptional there. In this situation, who is able to control the emotion, they will win. You need to control your emotions. Write down all solution, whatever you know. I'm just giving my example. In my exam in AFM, all questions were out of book, but then also I got 64. I don't know how I got 64. Understood now? Because I was also like you now. When we are student, we all are same. Got this point? So out of book ho sakta hai. Don't panic in that situation. This is only the last word I am saying. You have done a lot of things. You have done a lot of hard work. Now in exam, don't panic. This is the, I will say, if you panic in exam hall now, I say I want that only. First question will be dangerous question. If you don't know, attempt it, whatever you know, go to other question. Are you able to understand? Correct? I hope you have understood whatever I am saying. Sir, I was feeling less confident on India's money. Now, after today's revision class, I feel really hopeful on attempting questions. Yes, you can attempt. Even the new questions come and that you think that you are not able to attempt it, then also whatever you have understood, that much attempt. Suppose there are 4 parts, you know only one part attempt, automatically second part you will get the answer, third part you will get the answer, fourth part you will get the answer. But I am saying one rule, first 100 marks paper karke aana hai. Just do 100 marks paper. Correct? First rule. Second, if you don't know, then also answer it. Whatever you know, answer it. Means it is attempted. So whenever you don't know, then also attempt it. Got this point? One more suggestion I am giving. The question is out of book, out of syllabus. Out of syllabus it will not be. It is out of ICS study material. Attempt it. How much you can attempt. Don't panic in that situation. ICS want you to panic only. They want you to panic. They want that most of the people die in exam only. You don't die. You just your best. How much you know, give your best. The student who will panic, they will not be able to get good marks in exam. Got this point? Have you understood? I hope you have understood my words, and you just carry on this word till the exam completed. Don't discuss any paper. Don't come to YouTube channel in the last moment in the exam time. Don't come. Correct now. If you want to come for revision, then you can come for revision for that particular subject. But don't discuss this question paper with anyone, with any faculty. This is my suggestion to you all. We'll discuss the paper after exam, after all exam. Got this point? Okay, sir. Everyone, I hope you have understood everything. All the best for your exam. All the blessings are with you. Just give your best and then rest, and just leave other thing with the God. To give the best, everything depends upon God. God has God is always, God will be always, but with you only. Understood? Bye bye. Love you all. Love you all. But one thing, only after exam, FI exam, just message me how was your exam. Only this much. And will not discuss anything. Whether this revision lecture help you at that point of time, that also just write down and just leave it. I will not reply anything. I will say only congrats, best of luck. Only I will say this much. Best of luck for your AFM exam. Only I will say this. I will not comment anything. Got this point? Correct? Yes, I am the best. I am the chartered accountant and I will definitely become CA in this attempt. In this attempt. Okay. Bye bye. Love you all. Love you all. My voice will be in FR exam. In FR exam, believe me, you'll think about me and I will come in your mind. I will come in your mind to say that focus on paper, focus on paper. Don't deviate. Okay. So in your FR exam, I'll be with you. I'll be intangibly with you. I'll be present in front of you. Okay. You'll find my presence in your exam also. Don't worry about that. Don't worry about that. Okay, I I can't take my, because I know my voice has gone, but 3 days once again committed, so I need to go there also for this. But my all the best wishes again to all of you. All the best. Remember my words. This attempt you are going to become CA. Nothing else. Nothing else. Focus on your study. Don't leave anything if you have time. If you have time, don't waste that time. Utilize as much as you can. As much as you can. Bye bye. Love you all. Which part can we answer first, MCQ or descriptive? That is not yet known to us, because I think can be अभी क्या हो सकता है, I think quite possible. If suppose both the papers are given to you now, then you can do anything your choice. Correct now. But I will suggest first do MCQs. Complete it in less than 30 minutes. Then balance time you have for descriptive, because you started with descriptive. Now you will take 3 hours in descriptive only. I will say start with MCQs. First do how much you can do in that MCQs. Take 30 minutes for MCQ or less than 30 minutes, not more than 30 minutes. Take a target and 2.5 hours for descriptive. But if you start with descriptive now, you'll realize that 3 hours you have taken for 75 marks question only and you are not able to attempt MCQ. Correct now. Start with MCQ. This is my suggestion to you all. Got this point? All the best. Love you all. Bye bye.